Morgan, BlackRock, DTCC, Fidelity. The entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
You said it. You finally said it.
I'm so bullish.
Andy's bullish. I'm bullish. We're bullish. We're on 4th floor today. We're gonna be on floor 1, and then we're headed straight to the moon, boys.
All right. We are live and we are back. Happy Friday, everyone. Man, we're bringing the energy. It's solo. Andy dipped out again. That boy's going to surf the North Shore and discover Neo Finance somewhere in the Pacific Ocean. Guys, we've got a tremendous show, and we're going to get started very quickly. If we have some screen share, we can go ahead and pull it up, and we'll speed through it because we've got an incredible lineup. We've got Superstate, which just raised $82.5 million. They're doing incredible things. Next up, we have so first, we're going to be joined by SUMR Finance. They recently launched SUMR token. It's live. That's very exciting. Jim Hiltner is the next guest from Superstate. They raised $82.5 million. Pretty insane. And M&A season, public, private companies, crypto companies are going public. It's amazing to see. Then we're going to have Genius Terminal come up. Exodus has launched some tokenized stocks on Solana. We're going to be hearing from JP on everything that's happening in the tokenized stock world. There's some rumblings that the SEC and the CFTC are going to band together and throw a fantastic event. And we're going to hear a lot more about the tokenized equities market as a result of that. ChainlinkGod is joining us from Chainlink to discuss the Atlas acquisition. These guys at Atlas, if you guys are unfamiliar, are very deep in the MEV space. They come out of Fastlane, and Fastlane recently pivoted to the Monad ecosystem. So there's all kinds of crypto native, DeFi native underpinnings to this acquisition. We've got Marcin from Redstone. Redstone is not too happy about this acquisition. We'll see how that pans out. And then we're going to wrap up. Last but certainly not least, we've got Sandeep from Sentient, and he is going to close out the show because Sent from Sentient, another token generation event, is also live. So tokens are going live, companies are going public, companies are raising funds. It's pretty awesome to see. And guys, I'm sure you're keeping track of this because there is a bigger world outside of what's happening right here in our bubble of this industry. We have this whole debacle with Greenland. So Trump wants Greenland. You guys, I'm sure, have seen this. Will Trump buy at least a part of Greenland? You see this on the screen now. You also see we've got some updated call sheet in the ticker, some updated markets there. particularly relevant to the macro landscape. And we're going to be revitalizing some more of this in the coming weeks. 41% that Trump is going to buy at least a part of Greenland. There's a long date here, which I think is leading to the probability as to why this is priced at 41%. Greenland deal boosts market odds. This comes on the heels of Trump's speech at Davos and his meeting with the leader of NATO, I believe it's Mark Rutte. And he did this meeting right after his speech where he said he wasn't going to use force to acquire Greenland. But at the time, tariffs were still in effect. And so at the time, there was tariffs put on pretty much all of the European countries and the Arctic countries for not allowing this Greenland deal to happen. Trump halted the February 1st tariffs after talks with NATO on a Greenland deal. He says there's concepts of a deal or concepts of a framework for a deal. Very ambiguous. Prediction markets now put the odds of a Greenland purchase at 41%, with negotiations being led by JD Vance and Marco Rubio and Steve Witkoff. We can go ahead to our next headline because this is going to continue to unfold. And so we're going to see what comes out. But the boost in the market that we're seeing over the last couple of days is a result of those tariffs no longer taking place, at least for now. Okay, what have we got here? Chipang CZ reveals groundbreaking talks with 12 nations on sovereign asset tokenization. I have a feeling this also took place at Davos. You know, journalists and especially like, you know, when we see some of these headlines, love to embellish a lot of the things that happen here. We see it all the time when we're looking at TradFi. They love to make announcements. They love to say that we're exploring, researching, and developing what a potential solution could look like. None of these are action words. None of this is like, yes, this is what we're doing. None of it is definitive. And so what do I think happened here? I think CZ probably got into a room with a lot of countries and nations, and there's interest, right? And so he probably got in Davos and he was sitting around, and, you know, these people are very curious about how they can monetize their balance sheet, monetize their debt, kind of separate away from fiat currencies, whether it be, you know, the BRICS countries and the yuan, or if it's the US dollar as a fiat currencies. Countries and sovereign nations and central banks are looking to separate away from the world economic monetary order that has been established as inflation continues to eat away at these fiat currencies. That's why we're seeing the rise in gold and silver. And inevitably, we believe Bitcoin will be a benefactor of this separation away from fiat currencies as well. This is almost a prerequisite for the debasement trade. So we hear a lot about the debasement trade. The central banks are one of the reasons why they're actually going deeper into this, and they're starting to buy more gold. And so that is propelling the debasement trade forward. Let's continue to move forward in our headlines before we get our first guest up. Why don't we just cycle through a couple more, and then we'll get Chris in here in just a moment. So a whale is looping USDE, borrowing and accumulating gold. This is a great segue from our last headline about how central banks are accumulating gold. They're looking to separate from these fiat currencies because the world reserve currency and the dollar and the whole monetary power are starting to shift. And so what is happening here is that this whale, we don't know exactly who it is beyond just a wallet address, has borrowed USDE, the stable coin, to a tune of $42 million and has bought Tether's tokenized gold product, XAUT. This was with an unrealized profit of about $3.5 million at the time. And gold has continued to go up. Silver has continued to go up. Palladium has continued to go up. And I think that will continue to happen because, you know, if you look at, you look at Canada and you look at the Prime Minister of Canada went to Davos. He also talked about how this monetary order is eroding from the inside out. And Trump is only accelerating this with some of the neocon and imperialist natures of his foreign policies. So we're not going to go too deep into this rabbit hole, but it does have economic consequences, and this is one. Precious metals are doing this. So let's keep moving here. We're going to go and do one last headline, and then we'll bring our first guest up with Chris. What have we got up next? It's been a busy week here. It's been a short week, but a busy week. And last but certainly not least here, we've got RWA XYZ reporting that JP Morgan, the world's largest bank, is now live on Ethereum. So we know that their tokenized money market fund has deployed. It is live trading. There is a snowball effect here where if you look at RWA XYZ, you'll see that a lot of these tokenized funds don't have a ton of holders right now. There's not a lot of retail buyers that are buying this. There's a few, but by and large, we believe that the tokenization power is unlocked when all of the institutions are on chain. This is when a lot of the institution to institution flow is fully unlocked and happening on chain. And that's when we believe size, holders, all of these things will increase. And of course, each one that tokenizes its fund, moves on chain is a further success case to all of the other institutions that show, hey, this is really happening. And the liquidity effect is that liquidity begets liquidity. At a certain point, you don't need, people say all the money is going to be on chain. You don't need to get 100% of the money on chain. What happens is you need to reach some critical threshold, call it 50%. Once you have half of the money on chain, it becomes worthwhile for anyone who's off chain to actually join forces with the rest of the liquidity, because that is how capital and markets move more efficiently. So we're reaching the critical mass. The financial incumbents in the neo financial world and the legacy financial world are moving incrementally on chain. And it's incredible to watch because we believe this is a snowball effect that will continue. So guys, we're going to have a very short commercial break, and we're going to bring up our first guest, Chris from SUMR Finance. We're going to talk about launching a token in 2026. Don't go anywhere. We'll be right back. Yeet is built for big moments. The most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
Not your keys, not your coins. From the team that pioneered cold storage, Trezor has just released its new wallet. Guys, if you are still using hot wallets in 2025, 2026, you are missing the entire point. Secure your coins. Get a Trezor at trezor.io.
Go anywhere on chain instantly with Relay.link. Relay is closing in on $10 billion transferred. Go to Relay.link to bridge your assets now.
Money shouldn't wait for Mondays. Following its real upgrade, Polygon is now one of the fastest chains for stablecoin transfers and payments. Visit Polygon Technology to learn more.
Kalshi is the world's largest prediction market. You can trade on anything in all 50 states. Go to kalshi.com to trade today.
Talk to AI like your lawyer or your doctor or your therapist. Yours, private, and here today. Visit near.ai to have a fully private chat experience.
We are here and the time is now. Chris, congratulations on launching the SUMR token. Man, I want to hear all about what it takes and what it means to launch a token in 2026. Welcome to the show.
Hey, yeah, thanks for having me. It's been a busy week. It's a busy 24 hours as well.
Yeah, I bet. I mean, man, our audience is primarily founders and builders of other token products, right? And projects. And so obviously we've got retail and DeFi power users out there that, they want to know how they can, most effectively accumulate the SUMR token and how it's incorporated into the protocol. But I'd love to get the founder story over the last 72 hours, right? like gearing up for a TGE is something that a lot of projects are looking at, they're looking into, they're trying to prepare for. Give us a sense of like of what the war room is like in the 17 the 3 or 4 days leading up to a TGE.
Yeah. I mean, yeah, it's pretty crazy. There's a lot going on from various different teams and so on, like making sure everything's lined up. Like for us, it started like really like over a week ago, because actually the TGE was triggered by a governance vote, and so on. And and as we talked about, I think it was on Monday, right? We launched the Aerodrome's Ignition program. So actually for the entire week, like we've been just chatting with people in the Aerodrome Discord, trying to campaign for votes and so on, because the whole point of Aerodrome Ignition is effectively battling for votes from VE holders, and so on there. So doing that, making sure everything's aligned on the centralized exchange side of things as well. The market makers, that felt like it was last minute, like making sure everything was like deployed and like sent their liquidity and so on, and like dotting the I's, crossing the T's and so on, in the last few minutes. And then kind of almost the anxiety in a way, like the last 6 hours, and stuff. Like been around a long time, like launch a multi-collateral DAI, like launch a laser summer protocol when we launched automation like 22 and stuff. Like it all kind of feels the same, but like the token is like out of your hands, right? It's like it feels like the one that's least in control. But yeah, I'm pleased it's done.
Absolutely. And man, it's incredible. You know, you have a protocol, and you guys, I think, went about it the right way. You launch the protocol, you get product market fit. For anyone who's unfamiliar, we're up to how much in the SUMR finance protocol? It's billions at this point.
Yeah, well, it is on the front end. So on our SUMR 5 Pro product, we have about several $1 billion being managed through the front end, and have done for like 5 or 6. Yeah, for like 5 or 6 years now, we've had billions of dollars being managed there. On the new Lazy Summer protocol, it's about 80 million right now. So like lost some of the mercenary capital as soon as the token started trading, which is to be expected and stuff. Like we always had planned to lose somewhere between 15 and 20% there, as you see on every protocol and so on. But yeah, it's growing again, and it's an exciting time.
Got it. And so tell us how the token is going to fit within the broader, Lazy Summer and SUMR 5 protocol. What are some of the mechanics here, and what is the game theory that someone as a market participant in the protocol should be thinking about?
Yeah, 100%. So the Lazy Summer token, or just the Summer token, really is, we think is pretty unique compared to most DeFi tokens, and most tokens in general. Really, it has a dual reward system. So if you're a token holder, you can stake your Summer token, and then you'll share in 20% of all revenue that gets distributed from the protocol. So the protocol charges for its an AUM fee on its vaults, and 20% of that revenue is paid out to Summer token holders, crucially in USDC. So that money is charged, effectively converted to a USDC amount continuously, and once a month is redistributed to those that stake the Summer token. So unlike most protocols where kind of there's never really any economic value tied back to the token or anything like that, especially if you look at tokens like Uni and so on, the Summer token is very different. So you get that. You also earn Summer rewards as well. And the great thing about the Summer token is you don't have to go and buy it on the market if you want it. If you participate in the Lazy Summer protocol, then you earn Summer tokens. They're continuously streamed through Merkle. You can get them, you can stake them. The longer you lock up, the more the revenue share you'll earn. So it goes from a kind of 1x thing right now, all the way up to 7.2x kind of share if you stake for the full 3 years. So like we internally would describe it as like one of DeFi's most productive tokens. You'll get governance rights to decide on the markets that's supported within the protocol, and and then you share in the success. So if you're a Summer holder, if you can spread the word, grow the protocol further, then you're going to share in the success of that moving forward in a real like material way.
Yeah, I think it's something for other projects to take note of. We're seeing how the market is treating buybacks, and then also we have gone through this valueless governance token process. I think crypto is really having this realization where, look, we need product market fit, and it goes for the protocols as well as the tokens. Like we're going to end up in a world where there's equities and tokens right next to each other. And I think a lot of these market participants and retail buyers are going to think to themselves, why am I going to own, XYZ's, governance token when I can own an equity and it's performing pretty well? Or, earlier today we were talking about, tokenized gold and how, there's someone borrowing, some stable coins on Athena. They're looping it in order to lever up on tokenized gold. And that is possible because these things are tokenized. And so I think when it comes to the protocols, these are going to get, the ones that stick around are gonna find product market fit. They're going to have to. But I think when it comes to the tokens, there's things that you guys are implementing that other teams are not, implementing, or maybe they're thinking about. What would you say are some of the key things that, again, for a token to survive in 2026, what are they going to have to do? And what were some of the lessons that you guys took into account for the SUMR token?
Yeah, so I think you hit the nail on the head around. I think the protocol and the feature, the problems you're trying to solve for have got to come first at the protocol level. Like, there's no point like holding onto a token if the underlying product doesn't solve a real problem, because eventually those users that are using it, maybe just to farm the tokens, are going to move elsewhere. So yeah, we spent a long time researching exactly what the kind of customers, the users, even the institutions and stuff are looking for at the protocol level. And I think if you could build a successful protocol that has true product market fit, and then you have a token that can reap the benefits of that protocol. And I think that's the crucial bit. Again, when we talk about product market fit of a token, like, people want to be able to like get value from it ultimately for the end of the day, and then feel like they're part of something kind of bigger in a couple of years' time as well. So yeah, like, we took a lot of inspiration from Aerodrome's VE kind of lockup model and so on, and how they do that. We went with a slightly different idea of having the kind of stake position tradable, so that their token obviously is tradable after it's staked and so on. Like ours, you can't trade, but you can take a fixed penalty. So everybody can take the same penalty depending on the kind of time left of their stake, and so on. But again, it's about understanding, I think, what works. Like, we're in the privileged position of ultimately being able to see lots of different projects from a protocol point of view and from a token point of view. What works, what doesn't work. I'm sure we're going to see some new things coming up as well throughout 26. There's like some novel ideas and novel mechanisms kind of come to the fore as well. But yeah, we're super excited about the kind of protocol design first of all, and then the kind of token design to support the success of the protocol moving forward as well.
Yeah, well said. And so when it comes to the Aerodrome Ignition launch that you guys did, this is relatively new. I think people may still be somewhat unfamiliar. Take us through what it means to launch on Aerodrome. And you mentioned earlier, you got to kind of fight for your VE votes in order to allocate incentives. A lot of teams are going to go the high FDV, low float, launch on centralized exchange with their market makers. They're going to go that route. What are the trade-offs that maybe you had to go and realize by going in this Aerodrome DEX first launch path? But what are the benefits? Kind of, take us through some of the pros and cons.
Yeah. So the whole idea of launching through Aerodrome as well is it's like a fair market launch from a price discovery point of view as well. You 100% allow the market to decide the kind of price points to price that in as well. You can kind of like, it gives you a good idea with the votes as well, like kind of where your kind of price is going to land as well. Like, the Aerodrome community's got some great people that do some great assessments and so on, and like call out one guy, Roy, in their community that kind of like hit the literally right bang in the middle of his prediction and so on, of where it's going to land to start with based on where SUMR is today. But yeah, like it's a completely fair launch protocol and so on. And for us, it just felt right. Like, Aerodrome obviously is DeFi first, it's non-custodial first and so on. SummerFi has always been about that ever since its early days in Maker and so on. It's all about self-custodial kind of DeFi first and so on. I think if we try and push everybody on chain, try and like push them into this, like, hey, earn a yield on chain from the full, like the proper decentralized marketplaces ultimately, and then go down the centralized route to try and launch a token, it kind of feels like you're cheating or don't really truly believe in the technology side of it as well. The other thing is we've had the token live for a year, but it was just the kind of transferability and trading that enabled yesterday. So we've been building up all of the users across it. I know lots of protocols obviously do like points campaigns and build up those users, hit the airdrop at the exact same moment, and everyone is kind of a race to claim and then a race to dump off and things like that. But we already knew how many people like were actually holding the tokens already. We could see kind of the activity with it. They already were able to stake for a month before the token went live as well. So we could see the kind of like the difference in people, and like the average stake time was already over 500 days and so on. So like a lot of that liquidity was already off the market, for example. But yeah, like the Aerodrome is just it's a DEX first thing. The protocol is on the base network. And yeah, ever since we launched the token and protocol, and actually about 3 or 4 months before we launched it, when we knew base was going to be our home, was Aerodrome was one of the reasons for that, because of the kind of the launch pad they had. And then they introduced Ignition, which, yeah, you give a certain supply of your token. So in our case, we had 3% of our supply went to the Aerodrome VE holders as bribes. Effectively, they then vote to give their aero tokens, or vote to put aero emissions onto the pool in return for those summer tokens, and so on. And we know a large number of those kind of holders, because we've been in contact with them this week, have then gone and staked their summer into the summer protocol and so on. So yeah, like that was the ultimate goal for us, and hopefully, yeah, we continue to grow from here.
I think, you won't say it, but I'll go ahead and say it. And 3% is a lot less than what centralized exchanges are gonna look for. Like this bribing mechanism, it might be confusing to people, but this is exactly what's happening behind the scenes at centralized exchanges, right? Where projects are forced to give their token supplies over to a centralized exchange as basically maybe it's not quite a bribe. That's just the terminology that we have in the DeFi world, because it's sort of a crowdsourced network of liquidity providers. In the centralized exchange world, it's just one liquidity provider. They're going to go and make, the deals on behalf of their market makers and whatnot. And it's kind of like it's just a negotiation as far as how much of the token supply. But 3% is far less than what I've heard and seen from some of these other projects that are forced. If they want to list on some of these exchanges, I guess they're not forced to, but in order to list on centralized exchanges, it does cost them a significant portion of token supply, upwards of 10% is from what I've seen. So ultimately, the community is better off. Only 3% of the token supply, and then you do get the distribution of all of the liquidity providers that are on Aerodrome and part of the Ignition program. And so you mentioned now, staking is sort of the next available action that you would recommend that people do with their summer tokens. I'm just curious, like, what are the knock-on effects here? How do you think people should activate, their summer tokens? What should they do now that they have some tokens?
Yeah, so if they've got their summer tokens, they can head to summer.fi, launch the app, and connect their wallet. Inside the portfolio tab is a summer staking, a summer rewards section, and they can go and do what they want of their summer. I think the USDC yield on that summer right now is around 25%, and that only grows effectively with protocol growth as well. But yeah, they don't have to just choose one time period to lock up all their summer. They can choose multiple different staking periods. So if they want to put a portion of it in for 3 years, some of it in for 2 years, some of it in for 1 year, some in for say 6 months, and so on, they can go and do that. And like I said, they're continuously earning a little bit more summer from that, but the main yield ultimately is on the USDC side, on the protocol revenue. And there's a lot of plans behind the scenes to be driving that revenue upwards over the next year as well.
Yeah, let's get into that, because I think now, tokens live, you guys have, like you said, billions in the SUMR platform, upwards of 80 million in the Lazy Summer program, which, is enabling yield on, all of these tokens, especially stablecoins, great yields. And you guys are, crowdsourcing these asset managers, which is something that, we all believe is going to progress. What's next, right? How do we get Lazy Summer, from the 80 million to the 4 billion that's in the whole SUMR protocol? And then ultimately, how do we grow beyond that, and source, a lot more liquidity and a lot more yield, to ultimately benefit the SUMR token holders through this revenue share?
Yeah. So I think the main avenue of growth you're going to see this year on the Lazy Summer protocol is going to come from institutions. So last year was all about the kind of public vaults and so on, and a lot of work, but kind of behind the scenes on the institutional side. The protocol was designed ultimately for institutions first. Like a lot of the design and a lot of the kind of like modularity that you see in there, and the kind of segregation of control for different parts of the vaults and so on, is all designed for the institutional adoption and so on. So hopefully very soon you're going to start to see some kind of more public announcements and so on that side, and that's where we expect to see a lot of the growth. We also have some what we call DAO managed vaults for slightly kind of like more risk on strategies, so people that are more kind of open to taking on probably a little bit more risk, where the vault's not going to be actively managed like full time by a risk manager. but they will seek to achieve probably a slightly higher yield and so on. So they'll be pretty, I think, pretty good and pretty popular as well to bringing in more TVL on there. But yeah, 2026, I think as a few protocols have been talking about as well recently, this kind of move towards institutions. 2025 was obviously a huge year for kind of work in the background, I think, both for institutions and both for a lot of major DeFi projects as well. And I think 2026 is the year we're going to start to see more of that capital coming more on chain. So obviously a lot of capital went into ETFs and so on last year. There was a lot of kind of tokenized funds and so on. And yeah, I think we're going to see a little bit more happening with those tokenized funds, and going to start to see some vaults containing on some at least containing RWAs, kind of the money going to RWAs and things like that. That's yeah. I think the end of 2026 is going to look very different to how it starts this year on SUMR and across DeFi.
It's exciting times. I tend to agree with you. I think we're going to see an institutional wave coming. Right now I had, someone on the show the other day talk about just the quality of assets that are on chain. Look, we've got Bitcoin, we've got ETH, and we've got stable coins. And the breadth of stable coins is probably the most quality asset class that we have. Like meme coins lived and died. Like they're not here anymore. RWAs are slowly but surely coming on chain. And then you got Bitcoin, ETH. The rest of the alt L1 tokens are sort of cooked. And then you've got actual businesses that have chosen to tokenize. And this is where we believe that there's a lot of growth. You guys are an example here where there's actual revenue, and that revenue is shared just like an equities revenue is shared via dividend. There's shares, there's revenue that is passed along to token holders, whether it be in the form of buybacks or whatever. It is there, and there's product market fit for those tokens and those protocols. And so I think we're going to see a lot more of this. The quality of assets has to improve. I think slowly companies are realizing this, and legacy financial institutions are moving on chain, and they're bringing some of the more established asset classes with them. And I think all of this is going to help to sort of cleanse a lot of the token dilution that we've seen out there. And so, Chris, man, how are you approaching this institutional strategy? Like you mentioned, the way in which your infrastructure is modular and it's set up for this, and also like RWAs coming online. I agree. This primes you guys for what we're calling the neo-finance movement. And this is something that we believe is going to take hold in 2026 and beyond.
Yeah. And I've seen a lot of your neo-finance kind of like graphics and so on recently, which look really awesome. But yeah, I mean, from the SUMR point of view, yeah, like I said before, the vaults have been designed for institutions to be able to ultimately deploy their own vaults. Kind of the tagline for them from our point of view is they can get access to the entire DeFi market with a single integration. And the beauty for them is that we've done all of the technical uplift for all of that access, both on deployment and then moving forward. So we know that so many of these big kind of TradFi companies, like fintechs even, and so on, they have big technical roadmaps, quite often not humongous like engineering teams and so on, and at least like their roadmap or trying to get things in, it's 3, 6, 9 months away. And when we look at kind of DeFi in particular, like you support a protocol or a couple of markets today, and in a couple of months, there's another new market or another major new curator you need to support, or there's a new version of the protocol, or there's another vault and a new network that need access to, and so on. So with the lazy SUMR institutional vaults, they can deploy one of these vaults. They become a vault manager. They can have all of either their own capital or their users' capital access it. They're closed access vaults, so they restrict them only to their own users. That's how they then get access to private, like kind of KYC markets as well, to access the RWAs on there. But whenever they want a new market, a new product, a new protocol, they will come to us. We'll get the adapter deployed for them. Sometimes in a matter of a couple of days, if it's a brand new one and a slightly different to the kind of standards that we've already got kind of templated out, maybe a couple of weeks and so on. But they don't have to involve their engineering team for anything beyond that very first kind of integration, which is also fairly simple because they're standard 4626 interfaces. It's a deposit, withdraw, and kind of balance read function, and ultimately just for them. And whenever they bring on one new markets added, the automated rebalancing kind of features that they can take and can use if they want to will automatically just start allocating capital to those markets for them. So yeah, from a kind of engineering upkeep time for them, it's absolutely minimal, if not nothing. And then if it's a B2B2B or a B2B2C company, then they add their own revenue stream on top of those vaults, just like they would if they were like an ETF issue or anything like that. And now they've got a really solid revenue stream, continuously updating products to keep up with the market without any technical like kind of upkeep costs. And yeah, they're then at the forefront of all of this new like financial revolution, basically. Yeah. So yeah, it's a win-win-win for them. And yeah, and it's completely customizable, completely scalable, and kind of, again, whatever they want, they can have, all within the kind of infrastructure that we've built.
It's incredible, man, to think about the rising new cohort of asset managers as anons on the internet, but everything is verifiable and permissionless, and you can choose to whitelist or modularize like certain components of these assets, as well as the strategies that are taking place in these vaults. I think, you know, you put it extremely well, where you kind of give all of the same components, the privacies, the KYCs, the AMLs, all of these things, you know, you pass that along to the institution because that's table stakes for them. They need to maintain compliance. Exactly. They're regulated, but they want access to not only do they want access to the liquidity that's, you know, piling up on chain, especially as new asset classes and RWAs are onboarded and tokenized. They, I'm sure, also want the collective intelligence that is brought on chain by these asset managers, and these strategies are able to juice out, you know, we'll see how much more yield, right? Like,
yeah. I mean, I think,
yeah,
I think yields are pretty low at the moment, just because I think there's a little bit of like just general fear in the market of like the unpredictability and stuff in the market. And I think a lot of leverage is off at the moment, which is obviously pulled kind of DeFi yields down, and so on. But yeah, I mean, if this is a kind of a low DeFi yield environment, like we only have to look back at like late 22 and into 23, where the yields were like 1% or like less than 1% at times and so on. So if 4.5%, 5% is a low yield market at the moment, and that's the stage of DeFi we've got to, then I'll take that. And yeah, hopefully we get back to the kind of 9, 10, 11% we were seeing kind of like early to mid 25 as well.
That's the plan, man. That's the plan.
Yeah.
Chris, last question for you. If, you know, it's 6 months from now and, you know, you're post TGE founder, you've got, you know, the protocol, the token, you know, protocol's been live for a long time. Token, you know, now transferable, stakeable for, you know, 6 months. What is the number one metric that you're looking at, that you're, you know, judging success? Give us a milestone at which you're trying to hit here.
Yeah. It's TVL. TVL is the big one for us. This is the kind of like 2026 is that road to kind of 1 billion ultimately. Like we felt like we were on a good course for that up until kind of late October, November, just before the stream finance stuff. I think we talked about that on the last time as well. Like that obviously hurt DeFi quite a lot. You can see some of the other major protocols that have had a huge setback since then as well. But this is back on that track. It's the kind of institutions are the ones that gets to us that 1 billion. And yeah, I want to be like 6 months time on that path. But TVL is the one, because of the rev share that will then should in a somewhat rational world tie into the token as well. But TVL grows, revenue is growing, and then the token will do what tokens do in this market. But yeah, TVL is the North Star for us.
Nice. I think you guys are thinking about it the right way. Chris, as always, thank you so much for joining us, man. Congrats on the tremendous success in the protocol so far, and the launch of the SUMR token.
No, Robbie, thank you. Appreciate it every time. It's been great.
Absolutely. We'll see you next time, Chris.
Cool.
Thanks, man.
Cheers. Take care. Cheers.
Get some sleep. It's tough launching a token out there in the trenches.
Yeah. Yeah, it's been
Yeah, it's a doozy. Chris is gonna go get some sleep. That guy needs a break, but they're doing tremendous work. And guys, I mean, it is tough to launch tokens. Like, you are discussing with market makers. You're talking, you know, if it's on-chain partners, you're talking to on-chain partners. It doesn't stop. And ultimately, these are founders that are trying to deliver good products for you guys. You know, we want healthier assets. We want quality assets on chain. Ultimately, there's a lot of blood, sweat, and tears that are poured into these businesses. And so, you know, a lot of these businesses are choosing to launch tokens rather than, you know, go public or raise another fundraise and stay private and just retain all this value for themselves. What other industry is going to just go share revenue? Like, there's VC cabals that just stay private forever. not every company goes public, and here it's basically it's common. It's the most common to just launch a token, go. That's how you go public on chain. So shout out SUMR. They're doing great. Recently integrated with Hyperliquid as well. And so you can deposit on there and earn all kinds of yield generated from the Hyperliquid protocol. And so this is what we believe. It's kind of like a burgeoning category in neo finance. It's not old guard DeFi pool 2 token emissions. It's stable coin centric yield, and it's yield that is sourced from all over DeFi. And this is, this is only possible because chain abstraction works, modularity and interoperability works. And so now, yeah, we do have the opportunity to source yields from everywhere in DeFi, no matter the chain, and make sure that we're providing the best form of yield in the best form of collateral. And ultimately, these are higher quality assets that are available on chain and not available anywhere else. Our next guest is Jim. And so we've got Jim coming up. He is the co-founder of Superstate, and Superstate is doing amazing things in on-chain equity issuance. And so these guys are fundamentally very instrumental in the tokenized equities market. And we're going to hear from Jim. But first, I think we might have a couple more headlines that we could go over. Let's see if we can get some more news up here. Because there's plenty going on. And we're going to get Jim up as soon as he joins. So guys, you're going to want to reshape capital markets. Superstate raised $82.5 million. Just give us a moment. And what have we got here? 2025 crypto fundraising report, $50.6 billion raised, 1,409 fundraising rounds. Let's scroll through this a little bit. The 2025 cryptocurrency and Web3 fundraising market raised over $50 billion across 1,400 transactions, 1,000 with disclosed amounts, representing a 226% increase compared to 2024's $15.5 billion. Look, they're saying that crypto VC is dead. Meanwhile, look, we're got a 225% increase over 2024. This aggregate growth masks a critical market dynamic. Nearly half of all capital came from only 21 merger and acquisition companies. What? All right, let's run through these. And so 23.3 billion across 800 transactions, and then the other 22 billion across 21 transactions, only company acquisitions. And then we had some public token sales and IPOs. But let's go down a little bit more. This just goes to show that M&A is super hot. $22 billion in crypto M&A, which they're bucketing into the rest of these fundraisers, which is pretty interesting, the way that they've gone and done that. And so the way they are counting these deal statistics is that 2024 had 1,600 total rounds, 12% decrease in 2025, but obviously much bigger rounds. I think this is honestly no surprise. Maybe it is surprising just the scale at which this is happening, but when you look at it, we knew that there was going to be consolidation. Where is the strength in the market? You have to look. It's not in these VC fundraising rounds that are taking place in private markets. The era of those deals making money has came and went with high FDV, low float. They're no longer doing it. The retail market is onto them. And so they've gone and they're, these VCs are exploring other avenues, digital asset treasury markets. Whenever you heard of DATs, there's only like 2 DATs that have survived. Pretty funny how you hear of Bitmine, you hear of SharpLink, you hear MicroStrategy, but the DAT concept, the DAT meta, no longer really a thing. And so IPOs are quite strong as well. But the lion's share of this is coming as a result of acquisitions and mergers. Obviously, we saw Echo must have been one of those transactions. Let's scroll down a little bit here and get a bit more of a breakdown. 2025 capital and deals. So if you look at that middle category there is going to be the mergers and acquisitions one. Only 3 in 2024 and 21 in 2025, a 1,500% capital percent increase and 600% more deals, 6 times as many deals in 2025. So yeah, pretty interesting to see. And this just goes to show that, you might think VCs are kind of like this one size fits all. Some VCs are just not the same, right? And so you've got late stage acquisitions, teams that are looking at playing in this market. And then, you've got smaller VCs that are going into the depths of the crypto markets. Those guys are going to struggle. There's really not a path for, a crypto company that's maybe abroad and, is struggling with European legislation, which is not as friendly at this point as American regulation. So you're seeing, a talent pull back to the US. And at the same time, you've got a lot of these companies that are choosing to stay private for longer. And so I think a combination of this is, we're going to see more token launches, but the VC landscape is changing. The capital allocation landscape is changing. And this just goes to show where the action is. And it's in M&A, and it's in the later stages, because now there's actually a path for these late stage crypto companies to end up going public. And so you saw BitGo the other day. We see Anchorage Digital. We're seeing the likes of Franklin Templeton. Wisdom Tree is already public. Circle is public. Coinbase is public. There's a cohort of crypto companies now that are public in the US equities market. And I think this is a trend that's going to continue, especially because you have a lot of companies that are going and acquiring. And I think they're building out this repertoire, and we're going to see more and more of these companies go public. So keep an eye out for that. And this is a great segue, actually, to our next guest, because Superstate is reshaping capital markets. They are connecting financial assets with crypto capital markets through on-chain public listings and tokenized investment products. This is very, very core to the Neo Finance thesis. They're working with tokenization issuers to raise capital on Ethereum, Solana, major blockchains. They're also offering tokenized shares, right? And so we've seen New York Stock Exchange, NASDAQ, they've announced that they want to go 24/7 and they want to tokenize. So we're going to be talking about tokenization in general, as well as Superstate's latest fundraise. $82.5 million is quite the raise. So you can tell they're gearing up for some pretty interesting happenings in 2026. So let's bring up Jim without further ado. We're going to bring him up on stage, and we're going to talk about the raise. We're going to be talking about Neo Finance and how tokenization fits into this broader landscape of what's happening on chain, with on-chain equity issuance, tokenized stocks, and generally how we're seeing the legacy financial world come on chain. And so we're going to get him up here very shortly. All right. Jim, welcome to the show. It's a pleasure to see you again, and congrats on the big fundraise, man.
Thanks, Robbie. Thanks for having me on. It's good to see you.
Absolutely. I think a lot of people, maybe, this is kind of their first foray into Superstate. It's a mega raise that you guys have gone and done, which, is incredible to see. And it sort of validates a thesis that we've been working out over the last couple of weeks and months, which has been this Neo Finance thesis. We see it as sort of this evolution of what we're calling legacy finance. TradFi world is being forced to innovate at the same time. We see kind of the old guard crypto native infrastructure slop. They're going to have to evolve. They're going to have to grow up as well. And ultimately, this puts you guys at the center of what we're calling this category, which is Neo Finance. Tokenization is a really important piece of this as well. So just tell us about what the story has been, especially in recent months, as you guys have really found some traction and ultimately, leading up to this raise.
Yeah, thanks. Well, it's about time if you haven't heard of Superstate now. Now it'll be on everybody's radar. But we've been around, building out all the infrastructure, to your point, to upgrade capital markets for the last, better part of 3 years. So we're really excited about the raise. It's definitely a validation of the growth, that we have experienced, and that is right around the corner for us as well. And we brought in some great investors, Bain Capital Crypto, Distributed Global, Han, Galaxy Digital, and a whole host of other really great, both crypto investors as well as large, traditional investors as well too, and some strategics as well. Bullish the exchange is on there, and a whole host of others. So yeah, I think what we've seen, our origin story is really coming from Compound. So Robert Leshner is the CEO and my co-founder here at Superstate. Really the genesis of DeFi really came from Compound building out the borrow lend markets back in the early days of DeFi SUMR, and really kicking that whole thing off. And I think his vision from day one really was not just to make it available for tokens, but to make it available market structure for the traditional world. And aside from this just being a evolution of crypto markets, I think if you take a step back, and to your point, Robbie, like the demand from the investor community is to have better technology and better way to own their assets, a better way to move them, and more connected markets, and really bringing not just things from a crypto wallet of your Bitcoin, your ETH, your Sol, and your meme coins and your NFTs and whatever else is sitting in there, but to make it a holistic marketplace for all of your assets, whether that's your stocks, funds, you name it. I think you're going to find that this, the whole reason why crypto is great is because it has this, singular platform for capital market participants, whether it's, investors or issuers or intermediaries that really kind of connect the financial plumbing in traditional markets. That's all done very siloed and in very archaic systems. And just, because we've all experienced how great it is to self-custody an asset and move it into a protocol and, do financial activities, we want to be able to do that for things that, we have in the rest of our brokerage apps and other portfolios. And, this convergence of, taking what is a very, archaic system of traditional markets and putting it into tokenized form, really just gives a much better investor experience. And that evolution is really just kicking off now. And we have the regulatory tailwinds behind us to make this happen.
We had a panel of VCs on yesterday, and there was not much consensus among them, despite for the fact that there was not quality assets currently on chain. Like, we've got Bitcoin, we've got ETH, all of the L1s, a lot of the DeFi tokens, a lot of the things that have came and went over the years, not to mention the meme coins, right? Like, all of these things are just they're not the quality of asset that a true investor is looking for. And so I think this is why we're seeing the growth of RWAs. We're seeing the growth of tokenized stocks. And ultimately, I think this is why Wall Street is embracing this technology, because they also understand that there is a whole composable world of finance that can really upgrade their financial stack as well. You guys currently have two funds. USTB is approaching $1 billion. And then USCC is approaching $500 million, right? So there's significant product market fit here. I'm curious, how is this Series B, the $82.5 million that you guys raised, how is this going to further the upcoming goals that you have? What are the upcoming goals, and what are some of the milestones that you guys are looking to reach?
Yeah, we've been, very heads down focused on building our asset management business for the better part of the first, 2 years that we launched Superstate. USTB really, launched back in, 2024, and has really taken off over the last few years. USCC is a little bit younger than that, and has also found product market fit. But we had to build a lot of infrastructure, and I think you ask about how we're going to be deploying the capital that we've just raised. Is to continue to develop the infrastructure, despite having a lot of momentum and proof that the technology is suitable for capital markets. There's just so much to be done. We're on ETH, we're on Solana, we're on, Aave Horizon, where the biggest asset is collateral in their RWA market, with USCC being, a couple $100 million in that market. We're excited to expand that type of utility out into the Solana ecosystem, into other protocols that, we haven't been able to build yet. In the equity space, there's even way more to be done. We take a radically different approach. I think the broad category of tokenized equities breaks down into a few different areas in terms of like the approach. And, I think they all have their merits, but in the way that we look at it from the Superstate perspective is, we want the actual issuer to bring their assets natively on chain. And that opens up a landscape of opportunities for sophisticated investors that really don't want to hold a synthetic exposure to an asset. They want to hold the asset. And the reason why they're investing in the company is because they, want to have, voting rights. They want to be able to get the dividend. They want to be able to, participate in the upside directly of the company and have a relationship with that company. So I think, the way that we approach it as a digital transfer agent is the share of Galaxy that's on Solana is an actual share in Galaxy on Solana. And so, that opens up, more sophisticated institutional investors that, that want to hold the assets that they're investing in directly themselves. And it opens up, capital formation opportunities, which I think is what is going to be the big, growth story in 2026. I was listening in a little bit. You were talking about all the companies that have gone public in crypto. BitGo. We were at the New York Stock Exchange with the team yesterday. Really proud of their ability to go public. It was amazing to witness that firsthand, actually sitting there on the floor. But the wave of additional like large businesses that have either indicated they're going public or that are, in the process of registering or have already registered, there's a whole host of them that are out there. And, I think these companies are going to be pioneers like they have been in their businesses to also being pioneers on the capital market side as well too. And, with our model, we work directly with the companies. And I think, Wall Street is paying attention to this because, back when IPOs first happened, it was really, who do you have a relationship with at your bank, and you can sell them shares in this new offering. And now these syndicates and the growth of the investment banking capital markets has gone into things like Robinhood is a huge channel, SoFi is a huge channel, and it's because they have so much demand from investors that they can tap into to make the offering, as strong as it possibly can get. But none of these speak to exchanges or wallets in the crypto world. And we want to be that connective tissue for IPOs and other types of offerings, secondaries, ATMs, like you name it. Like capital markets writ large is a broad category. But because we work directly with the issuers, like we want to be the direct enabler to reaching folks that have a phantom wallet with billions of dollars of stable coins on the other side. And that is just not something that the JP Morgans and the Goldmans of the world are set up to be able to do today. Certainly they will be tomorrow and in the next couple of years, and they're all approaching the space. But I think we're, validation in terms of the round and the investors and the traction that we build and the customers that we work with is that we can, accelerate their time to market and, do this in a way that, certainly follows all of the compliance, rules that make the U.S. capital markets great today.
And yeah, that I mean, extremely well said. And I think, you've got my wheels turning on, capital markets at large. There's all these components. DeFi was able to kind of bite off a small chunk of that. But in order to really embrace this, larger world of the capital market world in general, there's so much more infrastructure and so much more depth to this than just a simple like lending and borrowing market. There's all kinds of compliance and complexities that are baked in. And so, we're seeing plenty of announcements. Like every day, it feels like UBS or Wells Fargo or JP Morgan is making another announcement or kind of a step closer into this foray. But, they haven't quite like really dove in head first, right? And I'm curious what you think could be like that moment that ultimately opens the floodgates. If you think that there is a moment, right? Because we've seen even JP Morgan has said, yeah, we're going to tokenize, we're going to go and do this and do that. We're going to offer, these things to our customers. But is there a moment that you think could open the floodgates here? And then, we'll see tokenized deposits and money markets and all kinds of tokenized assets and products, to the extent that, we currently see in legacy finance?
Yeah, absolutely. I mean, I think all of Wall Street is going to be running on blockchain rails. These things take time. And, when we first started our business, we talked to a lot of folks on Wall Street who, during the Gensler era, when we first launched Superstate, didn't really want to spend any time with us. And, now they're coming back and calling us and saying, hey, like we realize you've done a lot of really great work. And, we want to be able to work together so that we can bring our business into these markets. And I think, the inflection point is actually not so subtle. It's like the loudest thing in the room, which is stablecoins. Like the reason why Wall Street is so successful is because they can move money around between depositors, savers, investors, issuers, lenders, like you name it. The fact that there's an interesting thing that I've been paying attention to, which is the trajectory of stablecoins has gone up and to the right. Meanwhile, the TVL and DeFi has either been flat or somewhat down. And the break of the correlation between, like it used to be, there's more stable coins, there's more borrowing happening in DeFi. That means that, they were just tightly correlated, as like risk came off of the market, stable coins went away. Stable coins are never going away anymore. Like that's just never going to happen. And so I think what you'll see is, more sophisticated institutions want to interact with stable coins, and the collateral that they want to use in these markets is not, maybe it's Bitcoin, maybe it's ETH, maybe it's an LST, but it's not your like long tail meme coins. They want to use their stocks. They want to use their funds. They want to use other things as collateral. And it just takes time to onboard that. But I think, the mission that we're on, because we came from Compound, we could have sat there and continued to tinker around with the protocol and make enhancements and continue to operate as a contributor to that ecosystem. But we decided, hey, like, let's go bring a step function of growth to DeFi by onboarding in a regulated, compliant way, in a, highly tech sophisticated way, the assets that should be interacting with these markets so that, they can meet the demand that is growing on chain. And, if you're raising capital and you're realizing there's $300 billion worth of stablecoins, like, why wouldn't you want to tap into that market to go raise assets? Bitco raised $200 million yesterday in their IPO, which is a fantastic number. But, $300 billion versus $200 million, I'm sure, a lot of that demand can be filled with the capital markets on chain because the investors know that business. They want to participate in all of these, offerings. And, instead of off ramping it and doing it in your JP Morgan account or your Robinhood account, why not do that from your MetaMask wallet instead?
Yeah. I think you're absolutely right. And, we've seen the crypto sentiment on, it's somewhat apathetic, but a lot of these community sales are still doing extremely well. We know the capital is there. And I think once we do see the higher quality asset classes come on chain, that's when we're going to see a lot more capital velocity, and we're going to see this thing really start get going again. I know we've got about 7 minutes left here. So there's two things that I want to get your take on. First one is, Davos was this past week, and, the leaders were there, and, we had BlackRock's Larry Fink basically go out and say that, one blockchain to rule them all, which is something that we heard a long time ago, but we had this whole modularity frenzy, and then it was like, okay, well, there's a multi-chain future. We have chain abstraction. We have all these things. And, you came from DeFi, right? So you've heard this argument as well, but it feels like, as an industry, we kind of came past that. Now, legacy finance is catching up. Where do you stand on the one blockchain to rule them all?
One is a strong number. Like that is like, there's like no ifs, ands, or buts about one. I think few is a better number. And whether few means 2, 5, or 10, I'm not quite sure. And I think, there's different benefits to the architecture of different ecosystems. But I think, the challenge with having, so many different environments is it's, number one, developer misery, like keeping up with, a product on one blockchain and another and how they're all different upgrade cycles and not necessarily coordinated. Like it's tough. And like, just so capacity constraints are there. And I think, the reason why the US capital markets are great and, just capital markets in general is liquidity. And like, the more you have fragmentation, interoperability definitely solves some of that problem, but you still have assets, kind of in different places, and we haven't really solved that problem. So I don't know. I mean, there's 3 or 4 big cloud providers, right? I'm sure a lot of other people wanted to go after AWS, but like Microsoft, Google, and Amazon won. And like, that's probably going to be the same thing in blockchain world as well too. And people are going to have different risk tolerances. The Canton has been doing an amazing job growing, the institutional chain. But that's not everybody's cup of tea. And I'm not here to be spicy and say whether it's mine or not. But I would, folks have different viewpoints on whether public permission, private or not. Like there are different needs for each use case and user. And so I think you're going to have a few, not one.
Yeah. And you're right. There are different use cases. There's, different lanes in which you want your assets, maybe not commingled with some other assets. And so I think we realize this as an industry, and, that's why we have several different L1s. And, I think Larry Fink may realize this as well, but it's going to become, I think BlackRock probably launches some sort of chain. I think the question is whether they launch an L1 or a Rollup, right? And if it's a Rollup, then maybe it is part of Ethereum. We'll see. If New York Stock Exchange does what they're saying they're going to do, this is going to make extremely huge changes, right? Like they're talking about tokenizing and they're talking about going 24/7. Some people are coming in, they're saying this is hyper financialization. Why do we need this? I thought, there was supposed to be a break in the market so we could go outside and, spend time with our families. But on the other hand, this makes, capital more efficient, and, machines are doing more trading than humans nowadays anyway. I'd love to get your reaction to, some of the things that New York Stock Exchange is doing. How do you feel about this 24/7 thing? And most importantly, how do you think tokenization is going to change the way the US equities market operates?
Yeah, it's a great question. I think it's great to see folks like New York Stock Exchange, NASDAQ, both of them, the stalwarts of US exchanges are going directly towards the future that we envision in terms of things being on chain, but they have different architecture in the way that their proposals, if you read into the details, NYSE is still very fresh. I think they dropped something, what was it, this week, or maybe it was last week, but a lot more details to be seen in how that all plays out. But what I want to see is, the reason why we all love crypto is being able to interact with markets with your own assets and not needing to go through intermediaries. And so my fear is with the large traditional businesses that want to protect their, the economics that they have in their legacy businesses. I really hope that it enables somebody to go there with a phantom holding their Apple stock and trade on the NYSE and not need to go through a broker dealer. I would love to see, direct ownership and direct relationship with the capital and the investor, the issuer and the investor, without it having to go through DTC. Like these systems are great, but they also leave a lot to be desired in terms of you and I that are probably on one end of the spectrum that really want to, have things in our wallet and say, I want to go to Camino and use my shares as collateral to borrow against it. I don't want to ask for permission to do that. But, there might be others that don't have that type of mentality and they want to use a broker to go find them the liquidity or the borrow or the economics. So I think, having these institutions validate that blockchain rails are the future is fantastic. But it still remains to be seen on, where exactly things land in terms of the actual like specifics on the market structure. But 24/7 to me is one thing. And, that's cool. Don't get me wrong. Like Maduro gets taken out on a Saturday, right after New Year's, and like the only thing people can sell is Bitcoin. So like, I would love for that not to be the case, so that like people can hold on to the Bitcoin. They have other risk assets that they can sell. But I think it's really about global access. And so for me, when I look at the work that we're doing, it's being able to connect issuers to capital, regardless of where they are in the world, as long as they are not, North Korea or Russian, entities trying to do illicit finance. Like there should be access to individuals and institutions all around the globe that want to participate in deals and assets that they right now don't have access to. And so that to me is the future that will win versus the, closed door intermediary driven world that we live in now, even if it's upgraded on blockchain rails.
I think it benefits the American economy to democratize access and ownership and let people from all over the world access the American economy, invest here. That's one of the things that we're trying to drive home here, right?
100%.
Yeah. And I don't know if I think Nike stock might have been hot when they got Maduro. I don't know if it would have gone up or down, but I saw those jumpsuits were sold out pretty quick. Jim, man, absolute pleasure. Last thing I got for you is, 82.5 million Series B IPO season is super hot. Are we going to see a Superstate IPO here soon?
We got a lot of work to do. We're heads down focused on, building as much infrastructure as we can for the capital markets. Want to definitely, help upgrade Wall Street, but laser focused on executing on the mission. And, we'll see where the future heads, but definitely not anytime soon.
Very cool. Jim, pleasure as always. Thank you so much for coming on, and congrats on the last raise.
Appreciate it, Robbie.
See you next time. Thanks, Jim. All right. Jim's a legend. And Robert too. I mean, over at Superstate, these guys, they've been around in DeFi for that long. They built Compound. They know what they're doing. They know both sides of this industry because, they've been here. They've done it. And so I like that there's DeFi founders that have been in the trenches. Like they're going out now and they're going into the, Wall Street world, and they're raising Series Bs and they're scaling companies. Like this is what this industry is meant to do. And the industry is made up of the companies within this industry, right? And so it takes the companies themselves to go out and be mature, raise Series Bs, scale themselves. And as a result, they're scaling the industry with them. And so I think Jim and Robert are doing a tremendous job at Superstate. Always a pleasure to have them on the show. We're going to keep things moving right along. Next up, we've got Arman. He is going to be joining us, and this one is going to be a lot of fun, guys. So we're going to bring him right up. We're going to be chatting about the future of on-chain terminals, and I think the future of UX is going to get particularly interesting as we get AI agents, as we kind of evolve into this neo-finance landscape. We know banks are going to be forced to innovate. They're going to be forced to pay interest on their stable coins, and I think people are looking for this neo-bank-like user experience. And we know crypto UX has been broken for a long time. Arman, welcome to the show. It's a pleasure to have you here from Genius Trading. And yeah, man, we're going to be talking about terminals here. It's a pleasure to have you.
Thank you. Thank you so much for having me. And yeah, like you said, the UX has been broken for a while, and I'm excited to talk about how we plan on fixing that long term. Yeah, absolutely. It's your first time on the show. Why don't you just give us a quick intro and tell us a little bit about how you got here? Yeah, for sure. So as Robbie said, and as you could probably see on your screen, my name is Arman. I've been building in crypto for the past 5 years, coming up on around 5 years now. Kind of got into it through a very ideological build lens of sovereignty and freedom, and kind of the sovereign individual being a core primitive of how I want to see society evolve over the next 10, 15, 20 years. Originally kind of got into crypto was building in the block data space. So we were the same team, me and my two co-founders met when we were at university, kind of studying adjacent things in and around blockchains and data and how that data is computed. But we initially wanted to solve kind of the data legibility in crypto, the kind of issue of data legibility, where yes, it's amazing that you have this open ledger, but what good is it if nobody can actually read that open ledger, if the kind of common everyday user can't read that open ledger? And so we built a block data and block explorer company called Lore, which we decided to kind of move away from and move into solving the more pressing problem that we were seeing in terms of UX. So for us, the overarching theme has always been crypto has a UX problem. Originally, our thesis was around, well, that UX problem is around data. And as we kept going and as we kept pressing more and more buttons, we kind of just realized that the problem is less around data in terms of UX and more around how people are actually executing and transacting on chain. And that was kind of where the idea for Genius as a terminal was born. The kind of 5-second DLDR on Genius is we want to be the everything terminal for crypto. I think that's kind of the end goal, where users come on and the asset is the first thing that they see, not the network, not the chain. That kind of takes a backseat to the UX. And so kind of the one-liner, the elevator pitch, off an elevator pitch is and this is a funny thing that I like to say at ETH Denver, but like, let's have sex on chain, right? Like what does that actually mean in practice is kind of the question that we're attempting to answer at Genius. That gets people's attention, man. I think that's a great slogan. And it paints the picture well. Everyone knows what you're talking about. Like the centralized exchange experience is super smooth. It's super fast. It's cheaper, better, faster. Ultimately, that's what people want, but they want it on chain. And Arman, I'll just tell you a little bit about how we're thinking about this. We kind of saw that, the space was moving to this convergence point. Like these legacy, it's TradFi, but like mainstream media, it's not mainstream anymore. It's legacy media, like it's legacy finance. These guys are forced to innovate because they want access. Everyone wants access to these things. And so now
on the other side, you've also got a lot of the crypto infrastructure slop that doesn't have product market fit. That's going to have to innovate. They're going to have to, really do some reflection and a look in the mirror and understand like what they're doing is going to have to provide a better experience to the end user. And I think we're going to end up with exactly what you're talking about, which is a centralized exchange experience, but it's going to be on chain. And so it's going to be fast. It's going to be affordable, and it's going to be secure. And so the thing here has always been, if something's decentralized, it can't go as fast or as cheap as centralized. It's just the name of the game, right? How have you been able to overcome this? And how do you think about this dimension of, speed, this, scalability trilemma, the speed, security, cost trilemma that, we've learned so much about here?
Yeah. To be honest with you, I actually don't necessarily find, especially trading on Genius, and maybe I'm biased about this in particular, but I don't really think there's a huge latency discrepancy between what you're able to execute through, let's say, a DApp and what you're able to do on a centralized exchange, right? I think that a lot of that execution layer is up to us as builders to optimize and give you something that, let's say, the human this is a discrepancy between a centralized venue and a decentralized venue. So I think in that sense, the way that we're framing Genius is more, let's get up to par with the exact execution on the centralized side in terms of speed. And then in terms of fees and how that's structured, it's a question of incentives and where those incentives align, right? For us as the interface layer, and I'd love to talk a little bit more about this concept of the interface layer. For us, the incentive is obviously to keep users around long term and to keep fees down kind of long term. But we're not centralized in that the pricing power to the layers below us, right? So the LPs and the liquidity pools that we're routing trades through, that's something that we're just beholden to as an ecosystem DAX, let's say, for transacting on a decentralized exchange. But our bet kind of long term when it comes to why someone would choose a centralized exchange like UX, but still trade on decentralized exchanges, even if there is a slight tax associated with it, is access to opportunities happen at the speed at which they're created on chain, as opposed to waiting for a listing team, waiting for XYZ process to happen such that you can access it on your centralized exchange. And so a big motivating part of our philosophy in building Genius is, for the most part, people who have gotten wealthy in this space have done so because they've had they've had technical advantages, and there exists a massive technical learning curve when it comes to trading on chain. But there also exists a massive wealth of assets exclusively on chain that then, by the time they actually get listed on a centralized exchange, that alpha is gone. It's been captured by the people who are on chain first. And the reason that that pool of people has stayed really small, as we've said, is primarily because the UX has been terrible. So just to backtrack one quick second, and then I'll hand it back to you. It is, of course, your show. Yeah, I think just a summary is speed. We think speed, we're almost there, right? In terms of actually competing with a centralized venue, we're not that far off, and scalability will continue to get better on the blockchain level. That's less of a problem for the terminals per se, and it's more of a bet that just is where the networks will continue to go. And in terms of cost, there might be, because of the way that it's vertically integrated, a slight tax that the user has to pay. But over time, we think that tax is completely amortized to the cost of the opportunities that they're losing by not trading in these venues.
Yeah. I think it makes a ton of sense. And I think you've articulated the interface layer particularly well. For a long time, it was sort of this barbell approach. It was like, okay, fat app thesis on one hand, we're going to have all of this revenue, we're going to have all this TVL, and we're going to be able to monetize, a lot of the deposits that go into these smart contract vaults, DeFi projects, that sort of thing. And then on the other hand, you had, the layer one thesis, right? Why layer one's traded a premium at all is, because, well, they are the underlying infrastructure for this entire thing. The app couldn't exist without the L1 or the infrastructure underneath. And so, that was the whole fat protocol thesis. And so you kind of had this barbell approach, but what I think, you're articulating here and what people came to realize was this thing called the fat wallet thesis, which is what actually matters is the relationship with the end user. That is the interface or the portal through which they interact with both the apps and the base layer. And so if you're closest to the customer, you own the customer relationship, you kind of have, the first dib to take a tax. Everything else is sort of price set based on what you guys decide. walk us through like fat wallet thesis, interface layer. Is this the right way to think about it? And how do you think the market structure shakes out as a result of owning, the end customer relationships?
Yeah, I think this is the exact right way to think about it, right? When we talk about an interface layer and we talk about a terminal, we have to first define what a terminal is. And the terminal to us is just the interface layer to on-chain finance, right? And so this layer in itself, the problem that it's solving, I mean, I don't know. Specifically, I don't want to quantify it because I don't want to cap it. It's not because I want to inflate expectations. I think that the opportunity is theoretically uncapped on this interface layer because things will continue to happen and people will continue to innovate. But basically, you think about the last year and a half of on-chain finance, and you basically realize that the majority of that volume that has happened on terminals, and people have been speculating and trading speculative assets primarily through those terminals. And just like what we're seeing, there's a race now to become the default interface for on-chain liquidity, because as you said, that means as you keep going, you can vertically integrate the value stack. And that's kind of the way that we think about it, right? There's obviously the fat protocol thesis that we're not competing on a blockchain level right now. Right? We're totally okay with the existing infrastructure that exists there. There's the app thesis, which understandable, right? And that is also kind of the interesting thing about this theory is that I think both of the theories before this are kind of correct, right? And we kind of sit somewhere in the middle of both theories saying, yes, they are kind of correct, but there is no unification necessarily of how that value trickles back to the end user. So what we've realized is that there's maybe 6 or so actions that have emerged as the standard on-chain action things to do, right? And all apps basically have the same UI to do and accomplish these 6 things. You can add a colored gradient here, you can add an animation there, but ultimately it is kind of what it is at the end of the day. And so that's swapping, buying, selling, borrowing, earning yield, taking out leveraged positions, and more recently taking binary bets on outcomes. So outcomes trading being more polymarket. And so our goal really is to cannibalize every interface that I've mentioned in terms of accruing that value inside of the Genius ecosystem. I think that's where wallet providers and auth providers such as Genius, and Genius partners with other wallet providers. We aren't a wallet provider per se, and we're also not a traditional wallet in the sense of, you're clicking, you're signing, you're bridging, you're doing all of the UX associated with that. But I think in terms of the core behaviors that people are taking on chain, we want to move all of those in, and we want to be early to whatever's next. Right, so there will be a new emergent behavior that comes out as a uniquely blockchain-enabled behavior. We don't necessarily think that should be an independent UX. We want to absorb that into Genius, and that's why I said that the cap on how big an interface layer could really be for on-chain liquidity is effectively limitless. It's
the only cap I can think of is the amount of people in the world. But then again, you can think, AI agents are going to have even more, throughput and trading volume than maybe humans at some point. And so they're going to need their interface as well. Maybe there's, different interfaces for different species. Conversation for maybe a different podcast. But a question here is, in order to reach the levels of scale that you're talking about, distribution is critical. I was on a panel yesterday. We had Avishal from Electric Capital and we had Haseeb from Dragonfly. And we were talking about how intense products have reached scale, near intense at $10 billion. And so they are saying how, right now there's sort of this value accrual question, this monetization question about how these protocols should be accruing value and how they should be charging fees. But the result and the conclusion that they were speaking to was, don't charge fees. Like, the game is won once you've reached sufficient distribution where you can set the price and everyone else has to listen to you. And so, from your perspective, do you follow the same train of thought? Don't charge fees now. We need to reach meaningful distribution. And if so, how will you and Genius reach meaningful distribution?
Yeah, it's a fantastic question. I mean, out of the gate, when we launched with our funders announcement and our strategic partnership announcement with Easy Labs, we charged 0 fees, right, on top of what people were already paying the network and so on. And we saw, I think, one of the most successful launches of any terminal. I think for the first week and a half of us being live, we did more in combined volume than our nearest two competitors. We did about $8 billion in volume. And since then, we're kind of figuring out what the best way to do fees is. So obviously on a business level, we feel the need to monetize just on an pure economic model and viability level. We feel the need to monetize, but how we monetize and like what that monetization looks like long term is still the open design question for us, right? So right now we have the industry's lowest fees across any terminal. It's just kind of what people are used to paying. But to answer your question about long-term monetization, the answer to that might change. And so this kind of comes back to the idea of eating value and vertically integrating. It could be in the future that, let's say right now, Genius users are paying because they're paying both a fee to the interface layer and to the underlying DEX. I think at the point at which we reach meaningful scale through some of the strategic partners that we have, through the millions of active users that we have, and kind of presence that we've built through this launch and will continue to do so, what we can do is effectively launch vertical products like a DEX, right? So there's no additional fee on top of what you're already paying for the DEX, but you have this, for lack of a better word, a sexy experience, and I see, but you have this sexy experience on which you're actually trading that liquidity. The final little bit that I'll add is the biggest thing for us will just continue to be community building and regional community building. I think this is something that sexes have done extremely well over the past 6, 7, 8 years of sex dominance, has just been establishing local presence and being accountable. And I think that is something that decentralized actors have hid behind for a very long time. I'm appearing here, a lot of your guests appear here with full names and everything and faces. And I think that if decentralized liquidity and decentralized exchanges want a chance at that kind of meaningful scale, you have to play that kind of game and be legible to people where they are. And so that's kind of our strategy.
I can't help but think about it. Like, what is your perspective on like the agentic economy? Because I think you're absolutely right when you're thinking about how to monetize and balance monetization with distribution and scale. But I can't help but think a significant portion of the market participants in the next 3 to 5 years are, I have to think that a lot of them are going to be agents, right? Do you agree, disagree? And if so, how do you build an interface product that appeals to both? Do you segment? Do you verticalize? How are you thinking about the agentic economy as a whole?
If I'm honest with you, I'm confused about the agentic economy as a whole. And the reason that I say that is I can see a very real use case for it, right? Like delegatable wallets and delegatable agents. Like the delegatable wallets is already kind of a part of the architecture and infrastructure that we're building, and some of our partners have built as well. And so from that point of view, like I could totally see a future where wallet A is supposed to only farm, a particular strategy, and wallet B is supposed to take decisions on the fly and only do X, right? And I can see a world in which there's an agent for each tab on the Genius page. There's a spot trading agent, there's a perps agent, there's a yield agent, and so on and so forth. Like I can totally see a world in which that is the case, and I'm excited about that world, right? Like if you were to tell me, here's this thing, it's a robot, you give it your money and here's 14% at the end of the year, I'd say, thank you very much. I'll take that. I'll take 2. But at the same time, I think, a core philosophy of building Genius is real people. So while we're excited about what it will mean over the next year, 2 years, 3 years for those real people to have access to those agents, and we've definitely architected in a backwards compatible way to make sure that that's the case. At the same time, we want to make sure that we reach the real people first, who can then delegate to those agents and kind of go from there.
One thing that's a little bit more near term than the agentic economy is the evolution of what we're seeing happen on chain. And I mentioned this, I think, at the beginning of the segment, which is the legacy financial system being forced to innovate, and on the other side, the old crypto infrastructure guard, like that whole segment of the industry is being forced to realize, look, take a look in the mirror. We need to find some product market fit. Where we ultimately think this converges is what we're calling neo-finance. And one component of this is a breadth of new asset classes, because right now we just don't have quality assets on chain. We've got Bitcoin, we've got ETH, and we've got a variety of stable coins that are actually doing particularly well. But ultimately, we believe there's going to be, a rush of tokenized money markets, things that are paying 14%. take two, put fries in the bag, right? Like we want that, we need that. And so I'm curious, how does the interface to those kinds of products look different than the interface to speculative products like a Bitcoin and ETH? And you could even put, tokenized equities maybe into the speculative bucket, and then you can put, things like the money markets, the tokenized deposits into the other bucket. Do you segment this on the interface layer? It's just, there's so many assets out there. There's so many different ways that people trade. It can't be a one size fits all solution, can it?
No, it can't. It can't. I think it can be an aggregated solution and a unified solution. And I think the correct answer to your question is effectively it's a more mature interface, right? And so this is a question that we've been asking ourselves internally as well. Is look, obviously, if you go into Genius right now, you'll see a terminal that looks a lot like a meme coin trading terminal, because that has become the most legible UX over the past couple of years in terms of, this is an experience that people understand and that they want to understand. But to be completely candid and transparent on your show, I don't think that there are that many people left on the terminal side who have an incentive to continue to innovate and actually bring into the fold all of the new assets that will come on chain. And so this is a long-term persistent question for us as well. I know you had Superstate on the show just before me. And I think generally speaking, like, we're very bullish on the assets that will come on chain. And what we're trying to do right now is effectively shepherd that capital, the capital that has made that speculative return, that is used to a legible interface, that a speculative interface is legible to, and shepherd that capital into an asset class that may not be, 6,000% in 5 minutes, but at the same time may be something that actually brings on a much more significant part of the economy onto the rails that they're already using.
Man, I think we're at a very interesting crossroads here with prediction markets and 24/7 trading and the hyper financialization of everything on one hand, and then this new asset class that is coming on and using blockchain rails and getting efficiency, and can honestly, especially with like a high, a hot GDP environment, like can potentially reach 6, 7, 8, 9% just using the same relatively safe and secure methods that we've used for the last century. Just with a given macro environment. That's still not going to be enough for some people. Like, some people are still going to choose to look for 6,000% in 5 minutes.
Yeah, but those people are used to 6,000% in 5 minutes. If I were to give you an everyday person who ultimately is, I think that's the end goal of everybody in crypto. I don't think this is a unique thing to Genius. I think this is, when we say it's a global technology and it's a global product, it really should be a global technology. But if you were to say to just, and I love using this word, but to a normie, like, hey, I can beat your 2.5% or 2.5% that your bank is giving you, or I can give you access to just a yield asset class that is completely different. It's not legible to you at all, quantum than dollars in the traditional bank would be. I think at that point it does not, how it's generated, because people, ask anybody right now how that yield is generated and they don't know for the most part, right? And so I don't necessarily anticipate that being a big barrier blocker in the future as we keep going and as the terminal space keeps maturing as well.
Yeah. Well, Armand, it was an absolute pleasure having you here on the show. Just, before you go, give us a sense of what's coming up next for Genius. The people that are trading, they love it. 100 million plus of volume so far, I believe, maybe more at this point. Give us a sense of what are some of the milestones that you're targeting, and what are you putting your focus into in 2026 and beyond?
For sure. That 100 million is now around 9 billion. So we've around 90x'd since the time that we did the kind of intake for the show.
I've got to double check with our fact check, our team, our research team behind the scenes.
Yeah,
incredible, awesome, man.
It's been quite something. But yeah, in terms of what's next, right? I think a big part of what we want to do and what we want to enable is privacy on chain. We have an orchestration privacy solution that we're going to be bringing live to market. I think end of the year is a timeline that we're targeting on that. But as we keep going, I mean, the thing about what we're building as opposed to other Web3 protocols are building is it's less as protocol version releases and more as just keep incrementally adding more and more to the user experience that we possibly can, right? And so that means adding yield. It means potentially integrating prediction markets. It means adding as much as we can to continue to cannibalize. And we're going to be publishing a roadmap soon as well. We've publicly committed to a TGE date before April 12th. So like everything that we can do in anticipation of making sure that that is obviously successful for the community as well. And then continue in our longer term roadmap, which is we want the world to move on chain. We recognize that there is a need. There are certain features of centralized exchanges and things that are super valuable, like privacy, and build together for everyone in kind of our genius garden, if that makes sense.
It does. It does. And it says here in my notes, 160 million plus. So the plus saved them. They were actually, it was correct, but in all seriousness, congrats on all the success so far. Would love to have you back on the show around that TGE so that we can get a catch up on, what's happened since then. And then, everything that happens in post TGE world. So absolutely loved having you on the show. Armand, thanks for coming on first time, but I have a feeling it won't be the last.
Thank you so much, Ravi. This has been amazing. Thanks, guys.
See you next time. Thanks, Armand.
Bye.
Guys, we're gonna talk about this in our post-prod call. I don't know where the 160 million number came from. 9 billion in trading volume has gone through Genius interfaces, which I think just, it validates even more so what Armand is saying about the fat wallet thesis, the interface layer. We know where value accrues, end customer relationships, monetization at scale. I'd say that they've found some product market fit. And now, they're looking at meaningful distribution and looking at monetizing. So it makes complete sense. Guys, we're going to spare you a lot of the commercials because you guys listen. If you watched the show yesterday, you saw plenty of commercials. Next up, we've got JP Richardson, CEO at Exodus. This one should be great. And so we are going to get him set up behind the scenes. And then we're going to have JP come on. Guys, if you are unfamiliar, Exodus has actually been around a long, long time. They are now working on tokenized public stocks. I believe Exodus was a Bitcoin wallet. I think this is the same Exodus. We're gonna hear from JP Richardson as he comes up. And they are publicly listed. So guys, I think, it's important to take into account that there is a strong cohort of companies that aren't launching tokens. And these guys have significantly successful business models, right? Exodus is a wallet that I've actually used. I think going back to 2018, I was looking for a wallet maybe for Litecoin. I don't know. It was an OG Dino coin, and Exodus was one of the only wallets that supported it. And so I ended up using them. They had the first mover advantage. And Exodus is public. And so, this is, again, an example where, if you guys are in the US, then you can get on a broker, you can get on Robinhood, and you can access a lot of the same stocks that are available on the New York Stock Exchange and the NASDAQ. If you're outside the US and maybe you are looking for a tokenized representative of, the stocks that we have here in the US on the New York Stock Exchange. Ultimately, I believe we're going to see more and more representations of equities. Some of them are going to be natively issued. Some of them are going to be representations, but settled off chain. That's okay. Obviously, we want direct access to these financial instruments. You heard Jim from Superstate talk about why native issuance is so important. But ultimately, these equities are going to be side by side with the rest of our token economies. And so this is something to keep in mind. As you're building out what your portfolio construction is going to look like, there's a lot of tokens out there, but there's a lot of other assets out there. And part of what we want to do on this show, especially with this push into neo finance, is we want to help educate you on some of the assets that are out there that maybe you haven't been exposed to in the on-chain world, right? We were born on chain. I said to someone earlier, I I had a crypto wallet before I had a brokerage account. And so I think a lot of others are like this as well. And this is the lens through which they view the world, right? We're going to end up with more quality assets on chain. It's not going to just be Bitcoin, ETH, and then a long tail of stable coins earning yield, and then a bunch of meme coins that come and go. There's healthier assets and more quality assets that are coming on chain. We're going to see US equities on chain. And I think it is worthwhile to say to yourself, hey, even in this, this tokenized world where there's thousands of tokens out there, there's quality assets that, have been on the stock exchange, they've been on NASDAQ, and now they're coming on chain. It's worthwhile to take these into account when you're constructing your portfolio, especially as native issuance takes place and we end up with these things on chain. So we're going to get JP from Exodus on the show very, very shortly. I believe he's ready behind the scenes. There he is, JP. First time on the show. Welcome, man. It's a pleasure to have you.
Robbie, thanks for having me here. I'm excited to be here.
Absolutely, man. It's a pleasure to have you. I told a story, I think, before you joined behind the scenes, which is I forget exactly which asset it was, but I think it was 2018. I used Exodus for some asset. I don't remember. I think it might have been Litecoin, but it was something I used the Exodus wallet. And I mean, you guys have just been crushing it lately. A lot has happened since 2018. So JP, it's your first time on the show. Why don't we start? Tell us a little bit about yourself and how you ended up as CEO of Exodus.
Oh, absolutely. So yeah, back in 2015, my co-founder and we were kind of looking at the landscape, and I had a failed crypto startup already. It was actually, funny enough, it was a Bitcoin wallet, but I didn't have any design chops. But my co-founder, fortunately, had design chops from Apple, Nike, Louis Vuitton, a number of name brands. And so anyways, we were talking, we're like, well, wait a second. Mt. Gox, it happened maybe a year and a half before that. And there's, a lot of fear still in the marketplace. And we're thinking like, well, what if we were to build an app, especially a desktop app, which was underserved at the time. There was no desktop wallets at the time. And what if we were to build a desktop wallet that allows consumers to manage a whole portfolio of assets and allows them to easily one-click swap or exchange from one asset to another. So you have some Bitcoin, you want some Ethereum, you want some Dogecoin, whatever it is, one click, and then you can make that happen. And so that's where it all started.
Yeah, it's incredible. I mean, the forward thinkingness at the time to think that this is where it was headed. Now we've built out all this infrastructure behind the scenes, this chain abstraction, all these things that a lot of that infrastructure predated the modern smart contract DeFi world that all of us sort of know.
I don't even think DeFi, I don't even think like smart contract or like DeFi was even language or words even invented at the moment.
Right.
Well, someone that's watched would be like, no, Nick Szabo actually invented smart contract. Okay, you're right. But in the kind of the consciousness of crypto people weren't saying DeFi then. So you are spot on with that.
Yeah, man. And so, here at the show, my co-host who's not with us today, we've been thinking a lot about how we see this Wall Street legacy financial world and the crypto native world, how we see these two converging. And we're seeing a lot of tokenized equities come on, and you guys are getting into this as well. You guys are public on the New York Stock Exchange. And so, there's a convergence happening where these are two worlds. When they do converge, this becomes just one world. And we're calling this world neo-finance because we believe this encompasses tokenization, stable coins, fintechs, neobanks, and everything that is sort of this cross section as we have a lot of the currently off-chain assets come on-chain and we access them through a crypto wallet or a neobank or a modern fintech. And so I'm curious to get your sense of how, as a traditional wallet project, that again was ahead of its time with swaps and a lot of these features baked in. How have you approached some of the more traditional assets and financial mechanisms that are out there, like public stocks, and bringing these on chain? How are you thinking about this convergence of neo-finance?
A lot of people don't know this, but actually Exodus is the first company in the United States to actually tokenize our common stock and offer it to retail in a public offering. A lot of people don't know that. And we actually did it in the spring of 2021 is when we started on this journey. And so what it actually required is, so back in, I don't know, the summer of 2020, we were raising a Series A, and I started thinking about all the complexities of raising from venture capital. And I started thinking about, well, wait a second, we have this wallet platform that at the time, it was a desktop wallet, and then we had released a mobile wallet, I think about a year before this. And we're thinking, like, we have, likely billions of capital that people are storing in Exodus wallet across all of the Exodus wallets, right? Because we're a self-custodial wallet, but it's all across all these Exodus wallets, billions of dollars of capital. And so we're thinking, like, well, wait a second, hold on. Why are we trying to go out and list in the traditional, New York Stock Exchange or NASDAQ? Those great platforms, of course, but why don't we actually start with an offering directly inside of Exodus wallet to our customers and start there? And so we're like, well, how do we do that? How do we do that in an SEC regulated way? And so that's what kicked off the journey. And there's a lot more to the story, but that's what kicked it off.
And so 2021, you guys tokenized your stock, and now there's kind of this debate about, native issuance and represented issuance. But it is, again, you guys were at the forefront, right? Tokenizing back then. And now you have the New York Stock Exchange, right? One of the biggest, in the space, talking about how they want to tokenize pretty much all of their equities. What do you think that transition does to the industry? And generally, you've done this, right? You tokenized back in 2021, almost 5 years later. Can you say this was a positive experience? What were like the benefits and the advantages that you guys experienced as a result of tokenizing your common stock back in 2021?
Well, okay. So, there's an expression that says that, like, if you are a pioneer, you're going to take some arrows in the back from time to time, right? You've probably heard that. And so, when you think about the advantages along the way, there's one thing that really stuck out to me, and this was actually, it did not play out in our favor early on, but it's still very interesting nonetheless. So this was back in the spring of 2024, and I remember I was driving with my family to the airport because we were being invited by the New York Stock Exchange to fly out, ring the bell, and list and basically celebrate the American dream, right? And on the way, I remember we were looking at Twitter, or somebody's talking about the Twitter feed, and it was like, oh wow, there's this article that got published about Exodus tokenizes its stock on Algorand, and the SEC approves. And I'm like, this is going to be interesting, because remember, this was in the Gary Gensler era. Right. So we tokenized, and we did our offer, everything that we did, that this was pre Gary Gensler. Mm-hmm. And then when we were invited to list in the New York Stock Exchange, which was kind of to be legally compliant. Right. This was, in the Gary Gensler era where this headline was published. And this was also when Grok AI had just been released, so it was summarizing what was being talked about. And so that's not literally what the article said, but it was a Grok AI summary. So I'm like, oh, this is going to be interesting. So flying to New York, 130 friends, family, and employees celebrate the moment. And this was supposed to be on May 9th is when we were supposed to ring the bell. May 8th, we got the call that they were blocking it. That we could not list. Now, fortunately, we were able to do all this in early in January of 2025, and all turned out well post-election, right? Right. But when you ask about what did tokenization do for us as a company, there was one moment where it was like, oh no, like it kind of caused us to take a step back.
There's an arrow.
Yes. Exactly. But that's okay. Like, to innovate and actually, be a trailblazer on stuff, you have to be willing to take these risks, because now what you brought up earlier about the New York Stock Exchange actually creating a platform for tokenized equities for people to actually be able to settle instantly. It's going to be phenomenal. There's a lot more to talk about all this.
Yeah, absolutely. So that, a lot has changed, right? Even in just the recent months. But I want to get your perspective because, coming from that and then, going and doing the listing on the New York Stock Exchange in 2025, you've kind of came around to ultimately doing the thing that, had you in this position in the first place. And so give us a sense of, like, from your perspective, what has been so like the largest change, right? That has actually opened up this industry and enabled you guys to do the things that you were setting out to do to begin with? Is it just the Overton window? It's okay to talk about these things and actually do these things now. People aren't afraid, or is there codified regulation now? Like, what are some of the things that ultimately open the door to allow this to happen?
Yeah, you said it. You said it best right there. Like the Overton window alone, right there, is now. I mean, you have a pro SEC, or you have an SEC chair that is very pro innovation, very forward thinking when it comes to innovation, and especially when it comes to tokenization. You have, Larry Fink, the CEO of BlackRock, right? He's out at Davos a couple days ago talking about how, we've got to have tokenized equities. You've got Trump talking about America being the crypto capital of the world. So absolutely, like, the Overton window has shifted. You have the regulatory landscape that has shifted. And so now you have what I would classify as a very collaborative SEC that is actually sitting down and having meetings with people in the industry. I mean, you remember when Gary Gensler would be like, all you got to do is just call us up and come in and have a conversation. I mean, you remember when he would say that.
It's like Red Riding Hood and calling the wolf, right?
Oh yeah, absolutely. And so it's just wild to how things have absolutely have changed in the way that they've changed, and to have such a, again, forward-thinking SEC that's embracing the industry. And now what you have is like let's look at Solana for a moment and what's happening on Solana, right? You have the technology that Superstate has created as a transfer agent and has enabled on Solana, so that now you can take stock and you can go to Camino, you can take out loans on that stock, and actually you can start to inject traditional equities, but they're tokenized, into the world DeFi, and you can bring these together. And so I think there's so much potential from the instant settlement. I mean, we haven't even talked about dividends yet. Like the ability, like, can you imagine? Okay, so earlier you were talking about how you have the worlds of crypto and TradFi coming together. Now imagine a young investor, young Gen Z investor, Gen Alpha investor, and they're looking at whatever it is, Robinhood, Exodus, whatever it is, and they're looking at, like, okay, I can buy Coca-Cola, and it pays me out, 3%, 4%, whatever the dividend is, right? No, wait a second, I only get it per quarter, or I can get Solana, and Solana will pay me whenever I want it. And so tokenized stock actually unlocks that, so that you can pay dividends whenever you want. You could pay dividends in USDC. You can pay dividends in Bitcoin if you want. You can pay it in so many ways. So there's just so much potential on what can happen.
Yeah. And the power of tokenization is what you're speaking to here. And in addition to, like, the different assets that you can pay, you can also, I'd imagine you can pay, not by quarter, but you can stream it by block, right? Because you can split up those payments. And then, you can do things like, I was watching Tom Lee's presentation from Bitmine, and how, what you can do with tokenization is you can effectively split up the duration. If you only want exposure to the earnings potential of, say, Exodus in Q4 2028, you can do that. You can buy like a particular duration by tokenizing the time axis of these assets. And not to mention how you can split these things up, borrow against them, and compose them with the rest of DeFi. It's incredible. And JP, I mean, you've been around a long time. You were forward thinking back then. I have a feeling you're forward thinking now. Give us a look through your mind into the future, into what you're thinking comes next, right? Because we have tokenization, we have RWAs, stable coins. We see how these worlds are converging. And I'm curious to hear, with all the things that are happening and a friendly regulatory environment, what are you seeing as some of the next milestones to accomplish as an industry?
Well, I mean, I think like when it comes to tokenization, I mean, let's just talk real quick about one other aspect that we didn't even touch on. The notion of shareholder voting, right? Like right now, you get, like, if you have if you have stock in Tesla, Apple, or whatever, right? You get an email, or even sometimes some scenarios you get like a paper certificate mailed to your house, right? And you gotta sit down, fill it out, and that costs companies anywhere from $30, $50 to even $100,000 to actually do the proxy voting. Now, with having tokenized stock, actually giving people the ability to vote whenever you want. And no people haven't even thought about this, right? Like, imagine if you have your stocks tokenized, all of it's tokenized, and you have investors all over the world, and you're a very forward-thinking company. You're like, you know what? The people that are most invested in my business are my investors, obviously. Why don't we ask them to have a vote? Why don't we do this real time? We could have a vote every single day if we wanted to on certain product ideas, strategy, whatever. And so I think things like that are really exciting. I think another thing that's really exciting is to get into US equities like Tesla, NVIDIA. For investors outside the United States, depending upon the country, it can be really difficult. And so again, companies are going to have to start thinking about this, because like, if I'm an investor outside the United States, yeah, it's probably a little bit easier to get the Mag 7. It's really easy to get Bitcoin, Solana, or any sort of crypto, right? But if you have a tokenized equity, then you can have that available in almost any country in the world for those investors to easily get in and participate in actual real ownership. And I think that's super exciting.
Yeah, it certainly is. I actually was chatting with Jim from Superstate earlier on the same show. And we were talking about this, which this is part of the administration's mission, is to, accelerate investment into the US, right? What better way to do that by tokenizing these assets, tokenizing US equities, and democratizing assets access all across the world, and allowing anyone in the world to invest in the US stock market, right? This is one of the outputs of the US economy. It makes complete sense to open up this access, allow people to invest in America. I think that's one of the pillars that is a particular focus for this administration.
I 1,000% agree. And like, when you talk about, like, even you were talking about just the future, and even if we fast forward, you could start, and this is like maybe years and years from now, but people start talking about the convergence of AI and crypto. You could see a world where agents start creating tokenized equities. And yes, I know the regulatory framework needs to support some of these things, but an agent could ultimately start creating equity in the activities that it does, and the economic activities that it does. And then you could start imagining that agent is going to start raising capital on its own, right? And so all of a sudden you have what could be thought of as an autonomous economic agent, which is quite wild to think about.
Yeah. The world's going to get really weird.
It is, for sure. For sure.
JP, man, absolute pleasure. Congrats on all this. It's been wild to see Exodus, from using it in 2018 to having you on the show now is an absolute pleasure. Thank you so much for joining.
Appreciate you having me. Thank you so much.
Yeah. See you next time.
See you.
Thanks, JP. Bye. All right. JP's the man. First time having Exodus on. Guys, I think that is we're gonna start to have a tally that appears every time we have a publicly listed company on the show. We're gonna add another counter, another number to the counter, and I have a feeling we're gonna see some rapid expansion of that here in 2026. So our second to last guest, we've got Zach Rhines. His title is Community Liaison. He's better known as ChainlinkGod. Let's send him in. And we're going to bring him up on stage to chat about one of Chainlink's most recent moves. These guys, I mean, they're constantly they're constantly announcing things, and they're getting involved in the M&A space as well. Chainlink has acquired, they've acquired Atlas. And so we're going to be talking about what this means. You guys may have not heard of Atlas, but we're going to be hearing from ChainlinkGod exactly what Atlas is and how it helps Chainlink around this concept of SVR. And if you guys think back, I want to say maybe over a year ago when we were deep into the modular stack and we were looking at oracles and we were looking at Oracle extractable value. We were looking at the MEV space and all these things. SVR was something that came up quite a bit. And so we're going to get the latest in SVR from ChainlinkGod, Zach Rhines. Why don't we bring him up on the stage? And there he is, ChainlinkGod. Welcome back to the show, man. Absolute pleasure to host you as well. I so much has happened since I think the last time you were on the show was SmartCon. I got that right?
In person.
Yeah. It was incredible, man. I think SmartCon was one of these pivotal experiences in the last year, or maybe you've seen this from the Rollup. We're pushing and we have this thesis that the legacy financial space is being forced to innovate. They're being forced to not only pay yield, because stablecoins are able to do that according to Genius and maybe Clarity, but also neobanks, fintechs are kind of coming for their lunch. On the other side, DeFi, a lot of DeFi infrastructure slop has not found product market fit. And they're being forced to kind of take a look in the mirror and say to themselves, hey, we've got to go out and find product market fit like a company like Chainlink. This convergence between these two worlds, we think is going to end up in what we're calling like these business-driven tokens, these neobanks, these modern fintechs, and generally we're calling this category neo-finance. And, Chainlink has been crucial to this. And what I was saying is that SmartCon was a pivotal moment where I think Fidelity was in the room, BlackRock, DTCC, all of these guys were at SmartCon, but at the same time, Chainlink, like this DeFi Goliath, was the one that was putting her on this whole conference. And it felt like you guys were squeezing these two worlds together. Like I'm literally, I can just picture like these two atoms and like an atom bomb. You guys are fusing the two worlds together and like giving birth to this one new world of neo finance. And you guys have done a tremendous job of this. I think today I want to talk about how Chainlink's acquisition of Atlas helps to fulfill the vision that you guys are ultimately looking to achieve. Give us a sense, high level, what has it been like since you were last on the show at SmartCon? Give us a sense of what the vibes at Chainlink have been, and then we'll dig into the nitty gritty behind Atlas and how this helps Chainlink's positioning with SVR.
Yeah, definitely. And I got the same exact sense as you did at SmartCon, where you had both the DeFi, DGen, Web3 developer, the Aves of the world, mingling together at a Fidelity-sponsored conference with BlackRock and Swift and JP Morgan and all these employees and the people at these institutions who aren't just interested in Web3 and crypto and blockchains, but their title is head of DeFi, head of crypto, head of stablecoin. Like they're actual divisions now within TradFi institutions. And I think things have really only accelerated since then. We see the New York Stock Exchange announcing tokenization. Larry Fink's at Davos talking about tokenization, how it's going to change everything. Like it's only accelerated, and I think that a lot of the attention on crypto is also increasing just due to the discussions of the Clarity Act getting the market structure bill through. That's going to provide a whole lot of clarity that the institutions need to feel comfortable that if they build tokenization and then they deploy crypto solutions, that they're not going to run into any legal issues or ambiguity issues that's plagued our industry for its whole existence, pretty much. Once we have that market structure, and that market structure is one part of it, but it's also just the rights and the clarity around tokenization and tokens and self-custody and wallet interfaces and like how do you treat each entity. Once there's that clarity, I think that'll be the real unlock. And Chainlink's role in this world is just providing the infrastructure and the connectivity layer that enables an institution where if they want to tokenize an asset or build a DeFi style application, they're going to need the data to power that application. They'll need identity verification. They'll need the cross-chain connectivity. They'll want to be able to connect in their existing backend systems and their existing Swift messaging standards. Like they need this compatibility layer, this translation layer is usually how I like to think of it. And Chainlink's perfectly well suited. It's already the standard within DeFi. Aave, all these massive applications are been able to scale to the level that they have been able to get to today because they were protected by Chainlink data the whole way. And Chainlink being already the standard within DeFi, it's very easy to translate that to TradFi and say, hey, these standards are already being adopted. They've already been proven over the past half decade. You adopt these standards and you can speak the DeFi language. And you can put in, permissions and identity verification and all the stuff that institutions specifically need. But it's the same data standards. It's the same infrastructure, the same protocols. And I think more and more of institutions are realizing they don't need to reinvent the wheel when there's already this proven infrastructure out there. And I think this vision is just accelerating.
Extremely well said. And I'll just, the only part I'll add here is that in addition to TradFi being able to speak the language of DeFi because you are ubiquitous, Chainlink is ubiquitous with its price feeds across DeFi. Chainlink, you and Sergey, are doing the work to go into the legacy financial world, go to Wall Street and speak their language, learn their language, adopt it, speak it fluently, go into DC, do the same thing, speak the DC language to get regulation done. So absolutely. And in addition to going into that world and pulling them. So it's sort of like pushing DeFi closer to that institutional world and pulling it closer as well, which has been incredible to see for the entire industry. And you guys have not abandoned your DeFi roots. I think there is still very deep technical rigor and infrastructure that is taking place here. So it's not like you guys have gotten complacent. Job's not done on the infrastructure layer. This acquisition of Atlas speaks to how invested you guys are still in the MEV pipeline, in SVR. And Zach, I think you do a tremendous job at simplifying some of these more difficult to understand concepts for the layman, because there's a significant community that stretches far and wide. Give us the quick and dirty on SVR, and we'll talk about why Atlas is so crucial to further Chainlink's goals with it.
Yeah, definitely. I can provide a little bit of like a TLDR breakdown, because the Atlas acquisition is definitely, you need to have a little bit of context. The way I put it is that typically when you have a loan in DeFi and it needs to be liquidated, the way a protocol does that is it sells the collateral at a discount so that some MEV bot can come in, buy it at a discount, pay down the debt, and keep the protocol solvent. This is very, very critical to the solvency and the health of the DeFi economy. Anytime that there's a position that needs to be liquidated, it needs to be liquidated quickly, accurately, and safely to protect all of DeFi. In order to incentivize liquidations, protocols will pay a liquidation bonus, which is this discount. And that money typically gets kept by MEV bots and L1 validators. And a lot of this liquidation MEV, as it's called, gets leaked over the years. I think the number is about $300-400 million over the past few years has been leaked. Now, this value, these protocols are purposely paying for liquidations to happen. It's really important, but it's expensive. I mean, that's a lot of money that you're leaking out to these third parties who are keeping this value. So what Chainlink SVR is designed to do is that it's effectively an extension of Chainlink price feeds. So when a loan needs to get liquidated, what typically happens is that a Chainlink price feed will update. It'll say that the price of ETH is now, 2-5% lower than it was before. This position's now marked for liquidation. And typically this auction of who gets to liquidate the position happens on a blockchain. And the blockchain validators and MEV bot keeps the profit. And what SVR does is that it shifts the landscape such that rather than the who gets to liquidate the position auction happening in the blockchain, now it's happening in the Oracle network. So now all these MEV bots are bidding for the right to liquidate a position, and that value is now being captured by the Oracle network. And the Oracle network, which in this case is Chainlink, can redistribute that value back to the DeFi application. So to date, Chainlink SVR launched in March 2025, last year, together with Aave, the biggest DeFi lending protocol, and it's recaptured over $10 million in liquidation MEV to date. And that's split at a ratio between Chainlink to keep sustainable Oracle networks continue to operate, as well as returning that value back to the Aave and the Aave community and the Aave DAO to use it as they want to. And this has also expanded over time to being adopted by Compound and various other lending protocols. So the whole point here is that DeFi lending applications have been leaking a lot of value during the liquidation process, and Chainlink SVR is designed to recapture that value and return it back to the DeFi application.
Makes complete sense. The DeFi protocols have to maintain solvency as their number one priority. And like you said, they have to fire sale this collateral when it becomes bad, right? This bad debt. They have to sell the collateral to maintain solvency in the market. But they sell it at a discount. They don't need to sell it at so steep a discount. And that's where the leaky value comes in. They can sell it for a little bit of a discount. And this SVR Oracle auction helps, the MEV bots come to a more fair price rather than, really taking advantage of the lending market itself. And so give us a sense of, you mentioned over $10 million has been saved so far as a result of these integrations with Chainlink SVR. How does Atlas fit into this equation? And how are we going to help, to scale 10 million to ultimately 100 and $1 billion of SVR saved?
Yeah. So Atlas, that is what it's called a order flow auction protocol. So it's the actual protocol that's doing and facilitating the auction itself. And SVR has operated on Ethereum mainnet since it launched initially. And the integration, the merger, so to speak, between Atlas and SVR is designed to bring SVR to more blockchains, to the whole ecosystem. So with the announcement yesterday, SVR went from being live on Ethereum to now being live across 5 different EVM chains, and it can scale to any EVM chain that lending protocols are on. So it's really about just kind of accelerating what SVR is already doing. And I think this whole concept of OEV is interesting because I think it shows a clear pathway to how data feeds and price feeds can be monetized in a way that's not actually extracting value from anyone. I think when people think of MEV, they think front running, they think sandwich attacks, like, oh, who are you taking the money from? But in this case, the money is coming from MEV bots and L1 chains. And it's not coming from the users. In fact, it's actually returning value back to the users, back to the applications. So it's almost like this win-win dynamic where Chainlink oracles are able to operate more sustainably because of this source of revenue. And the DeFi applications and the DAOs have a new source of sustainable revenue that they can put towards building a better lending application. And MEV bots still get paid their share, blockchains still get paid their share, but they're not getting 99% of the liquidation value. They're getting a more equitable amount of value for the work that they're doing in those liquidations, right? So I think that OEV, while it's a very kind of niche kind of concept, it's like the liquidation plumbing of the DeFi economy. It's taking something that was very extractive and just leaking value to third parties who were just running liquidation scripts to now returning it back to the infrastructure that's actually securing the loans and facilitating the loan making process, which for me just seems like a more fundamentally fair deal for everyone involved. And I think that's when people hear MEV, they don't necessarily understand that you're actually creating a more fair distribution of value.
I think you make a great point. There's some people that might say, hey, like I run an MEV bot. I'm a person too. I want my fair share. But the result is MEV bots are still getting their fair share. They're just not extracting as much from these users as they were. But the MEV bots are still doing quite all right. I think this is extremely forward thinking for a couple of reasons. One is, obviously the multi-chain world is proliferating and we're seeing a lot of DeFi happen on multiple chains. So this acquisition makes a lot of sense to scale the Chainlink SVR approach. On the same note, we've got a swath of assets that are going to be tokenized. Like you mentioned earlier, New York Stock Exchange, is tokenizing. They're coming 24/7. We're seeing it happen. The RWA space, the tokenization space is taking off. This is a segment that's poised for a ton of growth. Earlier, we had Jim from Superstate. They recently raised 82.5 in a Series B. Incredible to see. And this, again, just helps to validate, where we see the space heading with this new asset class that is going to be onboarded. We're going to get equities, tokenized equities. We're going to get, tokenized gold and precious metals. And I'm curious to hear how you react and how you think about the scale of the DeFi landscape as a whole when we start to get, more tokenized money markets, more tokenized precious metals, more tokenized equities, and they become tokenized and composable with all of the same DeFi functionality. There was an example earlier. Someone borrowed $42.5 million of USDE from the Athena stablecoin and used it to purchase Tether Gold, right? XAUT, right? Which I can only imagine is going to continue to proliferate these types of use cases on Aave and Aave Horizon with their RWA protocol, powered by Chainlink. Like, with RWAs and the scale of tokenized assets entering the DeFi landscape, how do you react, and how do you think Chainlink is thinking about like where we're going and how we grow from here?
Yeah, that's a great question. I think in my mind, and maybe this is self-evident to everyone listening, but I think tokenized assets is going to be the next mega trend of our industry. You have just unbelievable trillions amount of dollars to come on chain. But I think when you think of why do you want to bring equities and stocks and bonds on chain, just bringing the asset on chain and then the asset just sits there is not that useful. It's useful when you can actually do things with those assets. For example, putting them into an Aave Horizon market and being able to borrow stable coins, or using it as collateral in a perps position and doing a delta neutral trade. Like, it's interesting when you can do things with it. I think what Chainlink does, the service it provides to asset issuers, is utility. And it does that for stablecoins. It does that for governance tokens and utility tokens. But it can do that, and it is doing that for tokenized assets as well. Okay, you've issued the asset. You have the proof reserves and the NAV data and all the necessary data. In order to make that useful, you need to be able to list it on Aave Horizon. You need to list it as a perp market. You need more data. You need more integration. And Chainlink is kind of this facilitator, connecting the assets to the applications and providing more utility to those assets. So, Chainlink plays, I think, a lot of roles within this new tokenized asset economy. But I think one of the big roles is making these assets more useful by being able to offer, hey, you're tokenizing a bunch of equity or a bunch of debts. Chainlink's already integrated as the standard across all of DeFi. For example, Aave Horizon, you can come get plugged into Aave Horizon, and Chainlink will provide the NAV data, the proof reserve data, the cross-chain interoperability to move it between the different lending markets. Like, it'll provide the glue that connects that asset into the lending market. I think that, in my personal view, DeFi is exceptionally useful, and it's been a great case study for what a tokenized asset economy will look like. I think a lot of these applications in DeFi today have been used for assets of maybe questionable value, so to speak. I think that there are blue chip assets, but I think there's also a long tail of things that people just want to speculate on. But we as an industry can very easily hot swap in tokenized assets as the asset layer and keep the same protocol layer. Maybe you need to add identity verification for permissioned assets. Maybe you need to add some more compliance tooling for the more sensitive jurisdictions. But it's the same infrastructure at the end of the day. And so the same role that Chainlink provides of securing 70% of the DeFi sector is going to translate one-to-one to securing hopefully 70% more of the tokenized asset economy, which is what Chainlink is building towards. So it's the role that Chainlink plays within this new tokenized asset economy is the same role that it's been playing and has been proven to excel at within the DeFi economy. So I think it's I can't be more bullish on the tokenized asset economy personally, and I think that Chainlink is very, very well positioned to be the plumbing of this new economy.
Yeah, I like the mental framing a lot of the asset layer. We've built out the protocols. We have all these blockchain layers and all of this plumbing in terms of the infrastructure. And I think you're absolutely right. We failed, to see that what's now missing is the assets, have to be just quality. We have to have quality assets. And for so long we've had, we do have our blue chips, right? But that we do have thousands of long tail assets that don't belong in the typical investor's portfolio, right? And so I think that is coming to a lot of people's forefront of their mind. We're also seeing in the Wall Street world, they're realizing all of the infrastructure that is here, and it feels like we're putting some of those final touches on, like those KYCs and those privacy elements. Those are starting to click into place, and when they do, it becomes fully ready for this asset layer to migrate on chain. And we're seeing it happen right before our eyes. And Chainlink is a centerpiece of that. And so, Zach, just I'll hand it over to you to close us out and give us some closing thoughts on what's ahead for Chainlink in 2026 and beyond.
Yeah, I think a lot of it's going to be somewhat similar in terms of continuing to secure the DeFi economy, offer new products like bringing SVR to more blockchains so that more lending applications can recapture value. But I think a lot of it's going to be focused on bringing institutions into production, getting them to a state where they can start to issue their assets at scale on public chains, on private chains, on whatever kind of environment that they want, using Chainlink as this orchestration layer to kind of facilitate the connectivity between their existing systems and their standardized approach of issuing assets, that they have trained thousands of employees and paid millions of dollars for their existing systems. They're going to want to reuse that in this new context of tokenized assets. Chainlink provides that translation layer, as well as providing all of the infrastructure for the applications that exist on public chains, both today and the applications that are going to be created in the future as a result of tokenized assets being brought on chain. So I think that tokenized assets adoption is only going to accelerate. Hopefully, the Clarity Act and Market Structure Bill gets enacted, and that provides the necessary clarity that industry needs. And I think that that's ultimately only a positive dynamic for Chainlink. That this recent acquisition of Atlas, it's focused on DeFi, but again, DeFi lending is in the tens of billions currently. If we're able to bring on tokenized assets, now DeFi on-chain lending can be measured in the trillions of dollars. And so the proportional value capture of the oracles and of the DeFi applications can scale with that linearly. The more liquidations that's happening, the more MEV to recapture, the more that gets captured in the Oracle network and returned back to the application itself. So I think that people are very bearish in the current environment, everything after 1010 that's happened. But I think the protocols that are building the infrastructure that will be used by tokenized assets have never been better positioned.
Absolutely.
We just need to, to my previous point, get the high quality assets on board, get the institutions engaged in these applications, and we already have all the infrastructure. Like we've been building this for since really DeFi summer, and so we just bring in the proper assets that people want to access, and all the infrastructure's there. So I'm very optimistic. I hope everything plays out. This year, tokenized asset adoption goes vertical. I think it may take a few years to fully ramp up, but I think this will be the year that things actually go into production in a meaningful way. So I'm very optimistic.
Yeah, and there are protocols that are well positioned to capitalize on this growth of tokenized assets and the growth of stable coins, which the powers that be are saying again trillions, and that's where we're headed. Zach, ChainlinkGod, thank you so much. Always a pleasure having you on the show, and looking forward to really this neo financial world that's taking place right before our eyes in 26 and beyond. We're going to see you again soon, Zach. Really appreciate you coming on and stewarding the Chainlink community forward. So we'll see you again next time. Always a pleasure, man.
Appreciate you having me on. Thanks, Robbie.
Absolutely. See you next time. Thanks, Chris. Thanks, Zach. All right. Zach's a man. Chainlink is doing amazing things. It's been a long show today, guys. Wow. We've gone through 5 guests today. Let's just do a quick recap before we play an interview that we recorded a couple days ago, but we're going to get Sandeep here and show that to you guys very, very shortly. We had Chris from SUMR. We had Jim from Superstate. We had Armand from Genius. We had JP Richardson from Exodus, and we had Zach, the ChainlinkGod from Chainlink. So an absolutely incredible show. I mean, Chainlink is blue chip in the DeFi world. Exodus is a public company. Superstate raised $82.5 million for their Series B. SUMR launched their TGE today, and Armand is doing $9 billion in the Genius interface. So pretty incredible lineup here, and it's only going to get better, guys. We're going to play our interview with Sandeep now, and then we're going to sign off, and we're going to have a great weekend. So let's do that, guys. Without further ado, we're going to take a very short commercial break, and you guys will see our interview with Sandeep for AI Supercycle and the Cent token. Time to get sent. Let's go. Yeet is built for big moments. The most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
Not your keys, not your coins. From the team that pioneered cold storage, Trezor has just released its new wallet. Guys, if you are still using hot wallets in 2025, 2026, you are missing the entire point. Secure your coins. Get a Trezor at trezor.io.
Go anywhere on chain instantly with Relay.link. Relay is closing in on $10 billion transferred. Go to Relay.link to bridge your assets now.
Money shouldn't wait for Mondays. Following its real upgrade, Polygon is now one of the fastest chains for stablecoin transfers and payments. Visit Polygon Technology to learn more.
Kalshi is the world's largest prediction market. You can trade on anything in all 50 states. Go to kalshi.com to trade today.
Talk to AI like your lawyer or your doctor or your therapist. Yours, private, and here today. Visit near.ai to have a fully private chat experience.
Havachi is fast and private perps trading, secured by ZK with Celestia underneath. Go to hibachi.xyz to start trading today.
Looking for yield that stands out? Infinify gives you just that. Deposit stablecoins and earn far more than the current savings rate. Infinify is a battle-tested, reliable DeFi platform that is ready to go. Head to infinify.xyz.
Halliday is unified crypto payments. Give your users more wherever they are. Go to halliday.xyz to never write a smart contract again.
Open, stable, borderless. Frax is building the next generation of stablecoin infrastructure for the digital finance era. Visit frax.com to learn more today.
Yeet is built for big moments. The most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
Not your keys, not your coins. From the team.
What's up, guys? Welcome back to the Rollup. I am here with Sandeep from Sentient, as well as Polygon. You guys see the shirt. You recognize the purple. We're here on an AI super cycle. This is our flagship AI segment. It is powered by Near. They're doing great job in AI, as well as Sentient, who is backed by Near. And I believe this is a partnership that's incredible. Sentient's got some big news. The token is live, or depending on when you're listening to this, it will be live very, very soon. And so Sandeep is here to talk to us about AGI, Sentient, and everything that is happening in the world of crypto and AI. Sandeep, you're a friend of the show. Welcome back, man. It's a pleasure to have you.
Thank you. Thanks for having me on.
Absolutely. Last time we saw each other, I think it was in Korea. We were on a panel together in KBW, and it was fun. It feels like a long time since KBW.
Yeah. I don't even, to be honest, like it got wiped out of my memory. Like it's so
Crazy.
long back. Which month was that?
What it was, man. I think we were talking about L2s and interoperability, like composability with L2s. Ben from Espresso was on there.
Which month was that? Which month was that last year?
KBW? Was it October, November?
Oh my God. It's like only 2 months, 3 months only?
So much happens, man. You've been busy.
I almost feel like I'm thinking like, was it in April, May, June? Like, this is October?
Yeah.
God.
KBW is back in October. What have you been up to since then? You've been busy. A lot's been going on.
Yeah, I mean, lots of stuff. You guys also must be watching on Polygon. We, just did 2 large acquisitions for around $250 million, and like going deeper and deeper and deeper into payments, and trying to create a new paradigm, like just like Ethereum and consensus added a lot of value back to Ethereum by building like a wallet and a lot of peripheral infrastructure on top. So same thing, like I'm converting Polygon Labs from like a pure play kind of a cost center, which is simply building the protocol itself, because the protocol is by and large built. So now start doing more profitable activity, building middleware, providing services with which Polygon Labs can make money. And then it becomes less dependent on the protocol and the token treasury sales to fund itself. So, I think we are going to see a lot of protocols and projects going to do that.
It's a more pragmatic way of thinking about things. It's like thinking about it more in terms of a business and a company with product market fit, rather than this new token powered like economic zone. I think it's a much more pragmatic way of doing things. Look, we spoke with Mark and John from the Polygon team. They're doing great work, and we were chatting with them about the acquisition of CoinMe and Sequence. So Sandeep, today I want to talk to you about Sentient, because by the time this airs live, the Sentient token will be live. Tell us about Sentient, and tell us specifically about why the token is so important to Sentient's protocol and the mission that you guys have with AGI.
Yeah, so basically, the mission with Sentient has been to empower the open source AI development, because by now it is very clear with everyone that we don't really want these AI, super powerful AIs to lie in the hands of, or rest in the hands of, few individuals as well as individual organizations. So that has been the mission of Sentient, right? And then since then, Sentient has done a wide range of research, like our reasoning framework called Roma became extremely viral for many weeks. It was the most visited and the most trending repository for open source reasoning across the globe, not in crypto, but like the overall AI space. And multiple research papers, from fingerprinting to watermarking to various different things, to culminating in NeurIPS, I think in November, December, which is the largest AI conference, and where I think we had multiple papers and conferences and everything on that. All of that research being trying to consolidate into a framework which kind of using the token incentives with the people and the institutions building on it, creating a system where all of these individual parties can come together and contribute into the open source AI. So I'll give more concrete example, right? Because it has taken us also a long time to reach a place where we can say, okay, even though we have built a lot of open source work, but how all of this gets combined into, let's say, one single product or one single offering, which can actually create a synergistic and self-sustainable and growing kind of sub economy within this within the Sentient ecosystem. And so where we have now landed with all of these research is essentially, obviously the whole world is becoming the agentic world, right? And what we realize is that, the way you have seen Hugging Face, right? Hugging Face is for models. The way Hugging Face became the go-to platform for models, where everybody, the bespoke engineers building the models, and then people can test those models and all that. And this was Hugging Face has been the place where you go and check out what is happening in the model space. And the world is moving from now models to agents, right? So essentially, because Sentient's reasoning framework allow agents to become more powerful, more accurate, less hallucination and all that. And so now we are building the Sentient Arena, which is basically, you can almost think of as a Hugging Face for agents, because we have done a lot of hackathons, like werewolf based hackathons and all that, where people will bring in their agents. And then there will be a lot of AI based personas built over. For example, let's take a customer agent, customer bot agent, right? For banks, let's say. And then a lot of people are building those agents. That is not of our interest, right? What we are interested is that how can you build an arena where all of these, kind of agents are battle tested against each other, against the automated AI bots with different personas. Let's say there is a persona of a end customer which is very angry, and persona of an end customer who's broke. And how do you deal with this? Let's say, the credit card calls. Like, how do your voice agent work on that? And so all of these things improve the agents, and then everybody can take home the learnings from there. They don't need to share their user data. They can anonymize the data. And then the overall sentient economy, the way we are thinking right now, these models are still evolving, but probably, once the data is open source, probably this will be BSL business license data, where the large entities of the world, and we have like some of the biggest names in the banking, in the AI world, who wants to want to do individual specific campaigns here, and they kind of like either buy or stake sentient into this in order to get the rights to the data, or they pay some fixed amount to get the data, and all those things. All those business models are on the cards, but that is what the sentient research team has been doing. Like, my role at sentient is more of a high level, strategic level things, like how this economics make sense, and this thing. While the sentient has 3 full-time co-founders, professors, who are doing all of this research and all that. And I think, like, I now feel at a very much comfortable place where I think all of the sentient research is culminating into one single product, which is connected to the token economy. And then there is a virtuous cycle which can reward all the participants of this token economy.
Absolutely. And this is something that you've had a lot of experience with at Polygon. And so you know how these token economies tend to work. You know how developing a product, getting product market fit, getting adoption for that ultimately is going to power the token, and the token vice versa is then going to power and fuel a lot of the adoption of the product itself. And it creates the virtuous flywheel, like you said. When you're thinking about the AI space, because, we've seen a lot of like talent vacuums, right? We've seen AI suck a lot of talent out of crypto, and crypto take a lot of talent out of Silicon Valley and AI. How do you think these things ultimately go in terms of AI on chain? Like, why is it so important that a lot of these AI agents and personas, like you mentioned, the ones that are able to train banks and help with customer service, and these far reach into every facet of the economy? And you mentioned earlier, like watermarking, some of these things that blockchains are able to help with. But why do you think it's so crucial that we implement blockchain as a fundamental piece that powers a lot of these AI agents?
See, I've always taken the other side of this. Like, I don't think that apart from, like, you doing payments, which has nothing to do with AI, like payments are payments, whether it's AI payments, human payments. Apart from doing payments and some very niche smart contracting behavior, I don't think that the AI and crypto per se has a lot of overlap, right? Crypto, you have to see crypto as a horizontal, which is financial rails, your trustless financial rails. And you have to also see, like, right now, AI is a sector, right? Eventually, AI will not be a sector. It's the same. The example is cloud computing, right? Do you say that, cloud computing is taking away resources from, like, if I convert you as like, it's taking from, like, VMware or virtualization or some other like server technology. It's a server technology. Now, healthcare, transportation, finance, everybody uses cloud.
Right.
Same thing is going to happen with, like, right now, that is happening with crypto. And the this thing is, crypto has major implementations and applications in the financial sector only. And this is what I'm seeing at Polygon, for example. The major segment has become the fintechs and the banks and these large institutions using crypto for payments and their other financial needs, right? Because in finance you need custom business logic and all that. But same way, I feel that AI will be one more horizontal, which will use crypto for payment rails, for like creating some sort of these economies where people can stake. Let's say people can stake Cent and get access to like a licensed data and things like that, right? So, but it is going to be one horizontal which is used across the industries. I think the same is going to happen with AI also. So these boundaries between crypto people becoming AI people or AI people becoming crypto people will be blurred.
Right.
And at the end, it will be a business build. Like Polymarket is an example, right? Polymarket doesn't say that we are a blockchain based, prediction market. Polymarket is a prediction market. Kalshi is a prediction market, right? And underneath rails don't matter. Underneath technology gets commoditized. Same is going to happen with AI.
Yeah, and there is strong overlap in the ethos, right? Because despite the infrastructure and the technology underneath, the mission of Sentient is that AGI is open source and it doesn't fall into the hands of one single entity that's able to control public perception.
Yeah.
And so I'm curious, how are you guys affecting this? What is it that Sentient is able to do, and what do you see out there as the biggest threat? Is there a particular company, entity, person, or concept idea that is misunderstood? What is the single biggest threat to open source AI right now, and how do you prevent that?
Yeah, see, the single biggest threat, and which has remained the same, is some of these models becoming ultra powerful, and then that risk is still there, right? Like everybody says that is like, I say it as, Elon Musk says 80-20, I say 99-1%. 99% AI is going to be benevolent only, in the sense that AI will not take over human race and will have brain of its own, and they will start ruling over human beings. No, but 99% AI is going to be an extremely powerful tool which businesses and countries will use to propel their strategic advantages. And the goal for Sentient and anybody else who is building in open source AI is that this access to this technology should be available for everyone, all institutions, all individuals, all sovereign countries, right? So that there is a balance of power. And that is the Sentient mission. Like, so, it's not like Sentient is only going to do this. Like, there are multiple institutes which are doing this open source. We work very closely with the universities. We having like two very reputed pretty, fairly famous professors, running this, gives us the access to that, especially US, university circle, India University Circle, and China University Circle. Some of these top people are working there. So all of the like-minded people who want to create a level playing field for everyone in the world in different forms. So we realize that with this kind of funding, where like the AI model companies getting funded $1 billion in one single day, right? Like, at the day zero, the seed round is $1 billion, right? And with that, we can't compete with the crypto kind of race to build an open source model, right? So we realized that that is not possible. So we initially started with some sort of fine tuning and creating like the domain specific open source models and making them public. But then eventually we realized that our strength is being creating, and we are compounding on reasoning, and we want to make reasoning available. Just to understand reasoning, what is reasoning is that you can almost think of the model is like a very vague analogy, but the model is just like your CPU, maybe combined with your RAM, right? Like all the weights you can assume that's the RAM. But your computer is not CPU and memory. Your computer also has a GPU. Your computer also has various different kind of circuitry with it, which actually makes it a computer. Similarly, if you want a business viable outcome, I'm being very careful in business viable outcome, not like a fancy outcome where AI writes a story for you or creates an image for you. If you want a business critical outcome from this, you need to have the model, and then on top of that you need to add reasoning. You can also apply to yourself, like when you think about it, like if I told you that Robbie, how will you post this video onto your channel, right? Your mind will immediately start thinking of steps that, okay, I will I will finish this, then there's the I will go to my video recorder, there will be this thing, the version of this, I'll go to YouTube, I'll upload at Twitter. Like, this is a whole planning that you did, right? So but then if you think, like meditate over deeply, you will realize that there are two parts of your thinking on this. Your one is there is a end goal function where we know that, okay, this is where I need to reach, and you will realize there is something in the background which is thinking that, okay, if I need to reach there, what is the first step, what is the second step, what is the third step, which is planning, right? So this part in the middle is actually something akin to reasoning, right? Like you have a base computational brain, you have the brain, but that brain is actually thinking. And our brain, if you see, like with different regions of it, they have all of these different activities, different kind of contributions to it. So right now Sentient is razor focused on this reasoning part of the space, because we can't, because building the core brain, the CPU, requires billions of dollars to build. And so there are other people who are contributing in the open source world for that. We are contributing in how do we build the reasoning frameworks, which anybody can take any model and then can apply on top of it. So right now, like there is an ecosystem team which is building a co-pilot for trading and these things, prediction markets and all that, by applying the reasoning on top of Claude code, right?
Okay.
So similar kind of things, like we will provide like this. You have the reasoning framework, take your, whatever model you want to use, maybe an open source model, apply this reasoning, you get better results.
Makes sense.
Take it to enterprises and all that. And then you go to the arena. Like now you have this reasoning agent. How do you make it better so that it can achieve 99.99% accuracy for business critical stuff?
Right. And you can have it compete against other agents that are also in the open source world that are reasoning, and you can figure out which one better, and then they can learn from one another. It makes complete sense. And it also generalizes Sentient to this reasoning framework, which is something that I heard you mention, that you can then apply to all the different agents. Look, even if you have a closed source model, you can still apply the reasoning framework on it. And that is when we can start to build and expand some of these models so that they have far reaching implications in agents, in like you said, Claude code and the entire AI world, so that we can really harness the depths of its power. But obviously we want, the entire stack to be open source so that we have full compatibility, full control over that, and it doesn't fall into the wrong hands. Sandeep, before we wrap up, thank you. And very well built. You guys got to give you credit. You guys built this, and it's very forward thinking. Before we wrap up, I want to bring it full circle to the token economy, because the token for Sentient is out there, and you also have Polygon that's out there. And so, could you help bridge these two worlds in our mind? How should we think about the full token economy? You have the Polygon token world, you have the Sentient token world. Will these have any overlap? And if so, how can we think about value accrual when we have the payment blockchain world on Polygon and we have the open source AI world on Sentient?
Yeah. See, definitely there are overlaps. As I said, that the crypto is just a rails for AI. So when Sentient actually launches right now there is like a lot of tidbits of these open source reasoning and everything available. But now we are launching the Sentient Arena. Then Sentient Arena will have these staking, things, payment related thing. You pay for the data that is, being generated after those arenas have concluded and all that. So that will be the revenue model in some sense for the Sentient economy, and that will be built, using wherever Polygon rails can be used. They will be used, they'll be used there. And then Sentient was already prepping up for launching a chain built on the Polygon ag layer itself. And as the arena and all more transactions come, and when the need be, then they will launch. Like, it's not like launching the chain for the sake of launching a chain. So when the transactions achieve a certain level of threshold, then Sentient is expected to, launch that chain. And the other part is like, otherwise these economies are fairly, acting at different levels. Like Polygon is purely acting at the transaction provisioning block space level. Sentient is more of an app protocol. Think about like Ethereum and Uniswap or Aave, right? Like, so Polygon is basically the base underlying rails, and Sentient is one kind of app that is being built on top of it. And whereas Sentient's, token economy is also like, with this arena, finally it becomes even more clearer that, anybody can come and participate in these competitions and all that, and whatever data gets generated, either they pay to the protocol, and that exactness into the model has to be done. But once the arena goes live somewhere, February mid time frame or end of February, at that time, like once the whatever data gets generated, either you get access to data by staking a certain amount of the Sent tokens and be a participant in that economy, or you pay a fixed price and then buy that data and buy the license for the data and do that. So that is the Sentient simple economy. And then those tokens and all that, like whoever are contributing open source participants and all that, they get rewarded in the Sent tokens. Hopefully enough amount of data gets created that more and more enterprises want to come and stake and then get access to the data.
Yeah, and ultimately providing this value for this entire economy, this entire ecosystem, provides a lot of value, and then there's a lot of stake in
Absolutely,
people
and not only in the
providing that.
crypto ecosystem. By the way, this will be available to everybody, every AI company. Literally, banks are now getting onboarded to it as we speak. That there is a like a large, probably $100 billion asset in management and all that, like bank, which is right now testing some of these things and all that. So as these things proceed, Sentient team is going to talk more about these things.
Incredible. Sandeep, always appreciate you joining us. And you've been really busy, man. You've been Sentient, Polygon, making moves all across the map. What's up next? What do you
It's been 8 to 10 years in crypto. Like, there is nothing, like, that's the thing, like, with crypto, I think for me, having both Polygon and Sentient like fully stand on their feet, because crypto, like, I have seen the crypto crazy cycles, like with Polygon and all that. What I really, really yearn to build is these self-sustaining multi-decade companies. That is what inspires me to do. Like, so I am more focused on systems thinking, strategic moves, and creating an environment where these entities can build sustainably over time, not like a flash in the pan. 2 years your token pumps, like this thing, and after that you are like nowhere to be seen. That is my biggest fear, basically, that oblivion of my companies that are building in the space. I hope that they stand the test of time and become a part of the fabric of crypto.
The walk away test, right? That's what Vitalik calls the walk away. And man, you're not going away anytime soon. Continuing to build. Sandeep, absolute legend. Thank you so much for joining. Always a pleasure, man. And best of luck with Sentient token launch.
Thank you so
Cheers,
much.
brother.
Thank you. Thanks, Rob. Thanks, Rob. Bye-bye.